It does feel like for the first time in a while, the market has really been attuned to downside risks and growth.
The economy is clearly showing signs of deceleration.
I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
In the next couple weeks, we could start to see just a continuation of the softer economic momentum.
A sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
It's NVIDIA's world. Or is it? Welcome back. This is Bloomberg Surveillance for our audience worldwide. Anne-Marie Hordern, Danny Berger, I'm Lisa Abramowitz. John Ferro off until Thursday. We begin with a sort of question around NVIDIA. Yesterday, we saw a $430 billion sell-off over the past 3 days in shares of NVIDIA. Huge declines. Or are they? Danny, how much is it NVIDIA's world that we're all living in?
I have to say, this is probably one of the most constructive sell-offs we ever could have imagined for NVIDIA, because sure, the most ever for any stock selling off that $430 billion. But the S&P is only down less than 1% for those 3 days. It feels more like just a month-end rebalancing of shifting in to some of the losers. It's a technical thing. That's the flavor of it, not necessarily a fundamental thing.
I have a lot to say on that. I don't know that I totally am on board, considering that there's a 140% gain in these shares that year to date, including the 13% sell-off over the past 3 days, and the $400 billion of market cap is greater than the market cap of Johnson & Johnson, Home Depot, Merck, Bank of America, as well as Netflix. Anne-Marie, there is this question. We'll get to it. You can rebut but we can debate this the entire show. It raises this question, Anne-Marie, in my mind. How much were people pushed into NVIDIA because there was no other visibility on anything else, given some of the political uncertainty?
Well, when you have JP Morgan coming out with a note talking about the shrinking share of stocks that are driving the climb in U.S. equity futures, and then you start looking at, is this the summer of malaise, as Greg Peters is calling it, a PGIM? He's going to be joining us. And he's talking about the fact that if you are an investor and you think November, and politics has become a big issue this week because the debate really kicks off the season, if you think that it's a coin toss, November 5th, then why would you do anything other than hunker down right now? And potentially that's what people are going to start to do.
And it raises the question of what is hunkering down? Is it just buying NVIDIA? Or to your point, Danny, and I think it's a really valid one, there are other stocks that have offset the decline that we saw in NVIDIA, which raises this question, is it any company that can deliver cash flows and people see a lot to like?
Well, I guess the question is, if it is month-end rebalancing, that doesn't necessarily mean people like the small caps and the underloved stocks. It's just a simple shifting because they have to, because certain correlations, certain things got out of whack. I guess the question is if you're worried about election risk, I mean, can you really buy some of these smaller companies? Can you really buy duration if you're worried about the fiscal deficit? I think you're right. I think you need to sit on your hands to some degree, but I'm just not convinced what we're seeing right now, Lisa, is any clear trade. I really feel like it's technical.
That's a very fair point, which is the reason why people are doing a lot of technical analysis this morning to try to figure out, are we there yet? And can they go back in? Just to your point, Anne-Marie, Saira Malik of the Nuveen, the CIO, who's going to be coming on the show later this morning, pointed out that by the end of 2024, more than 4 billion people, representing close to half the world's population and 57% of the global GDP, will have participated in national elections during the year. The implications of this are dramatic, and yet it's so hard to predict what those are going to be.
It's really hard to predict, but now people are really starting to focus in on policies, especially in the United States. Axios this morning is leading with an article, a letter they saw from 16 Nobel Prize-winning economists, and they're talking about how their headline is that Trump's policies, notably tariffs, are going to be an inflation bomb. So you are going to start to see people start looking at potentially some of the noise and the rhetoric from what policies could be and what that'll mean for the real economy.
And that's the reason why people are watching the Treasury auctions coming up later today, kicking off the week. Just wanted to throw that in there. Meanwhile, in the markets, you could see crisis over. NVIDIA shares up 3.4%, so everything is Goldilocks once again. S&P futures up 0.2%. The outperformance coming from the tech names because of NVIDIA. So even though, maybe they don't drive everything, those shares are really conducting a lot of the market activity under the hood. Euro just fading just a touch, weakening versus the dollar, 107.25. It's basically been stagnant in this area. 10-year yields up just marginally, but down yesterday, really flat. The stability in the Treasury market is really notable after so many period sessions of just incredible volatility, and crude still hovering around that $81.30 level. Coming up, Sarah Hunt of Alpine Saxon Woods, with stocks coming off 3 days of losses. Sarah will be with us for the full hour. Peter Tchir of Academy on the geopolitical risks facing markets. And Bloomberg's Mandeep saying, guess what? On NVIDIA, whether it matters, whether it is the crucial stock for this market. Let's begin with our top story. U.S. stocks suffering 3 days of losses following, that's right, NVIDIA's slump. Saira Hunt of Alpine Saxon Woods writing this. We see the U.S. spending boom on AI continuing, perhaps to the detriment of other technological spending. Whether it can continue to drive equity markets will be the question, and the blistering pace thus far this year seems difficult to sustain. Saira joins us now. Saira, good morning. Thank you so much for being with us and waking up at this hour. Let's just start with this question of, is it NVIDIA's world and we're all living in it? Or to what we heard from Danny, is this basically evidence of the resilience of other names that can pick up when NVIDIA falls down?
I think to the extent that we have the market wants a theme and a story, it's NVIDIA's world and we're all living in it. To the extent that there are other parts of the economy that are starting to participate in certain ways, it's a dual thing that's going on. It's not just one thing. And I think, given how fast NVIDIA moved, it's not shocking that it's having some sort of a pullback, but it's not like retracing all of the insane gains that it's had thus far this year. So to us, it seems sort of normal that you would have some sort of a pullback. It was a very fast pullback and probably a little quicker than people expected. But that seems a little bit like you need to digest some of this, which is a word I hate to use in the markets, but it's true.
Well, that's the reason why maybe people are buying today. Maybe this was a dip. It was buyable, even though the shares are still up 140% year to date. There is this larger question, though. What does it do when one company can rise or fall and create or erase the market capitalization of some of the biggest, most well-known U.S. companies out there? What does it mean in terms of how much this market depends on NVIDIA to keep gaining, to keep going forward, and frankly, for the success of the U.S. economy?
Well, I think it is the poster child for the AI story, and the AI story has driven a lot of the technology performance year to date. And I think that it is the big growth story out there. It is the big technological revolution. The question is going to be, what are the use cases? Right now, people are scrambling to put in infrastructure that can handle these large language models, and that's where NVIDIA is getting so much traction. That's going to continue. The question then becomes, okay, now I have that infrastructure. What do I do with it? There may be a pause there, too. But right now, the driver is, I have to put in a brand new technology infrastructure, and that's going to be expensive, and I have the money to do it because all of their customers are sitting on a lot of cash. So right now, that's a major growth driver, and people are responding to that.
See, that's the thing. A lot of people question NVIDIA and say, at some point, this thing needs to come back down to reality. The thing people have a harder time grasping is what that thing is. You mentioned this idea that at some point, people will build up this infrastructure and take a pause and say, okay, what do we do with it? Is that the catalyst for it to come back down to reality, or is it something else?
It's hard to say because I don't know what the pace of that is going to be. Right now, the pace is blistering of what people are spending money on because it's a land grab. Everyone is jumping to say, I have to get these servers together. I have to get this capacity, and I have to be able to handle not just one large language model, but possibly more than one. So right now, the scramble and the spend is on getting that done. Microsoft's making money on ChatGPT. That's one of the reasons that Microsoft is doing so well. Who else is going to be able to jump in there and do that? And how fast is that going to happen? And I don't think we have the answer to that. I mean, I think the expectation is it's going to be great and it's going to be fast. We don't know yet.
Well, see, I think that's such a good point because one way you could look at NVIDIA's revenue is, as you say, it's these other companies' spend. They're putting huge amounts of money into it. So Microsoft, sure, a winner, they can monetize it. But are we potentially overlooking some of these other companies that are, again, plowing money into NVIDIA, the viability of that actually paying off?
I think the question is, like every other technology, what people expect the use case to be is probably not what the use case is going to end up being. But we still don't have an answer as to exactly what that is. So to the extent that we don't know where that's coming and that something might come in and all of a sudden people realize, oh, I can use this to do that, then you might get a new set of enthusiasms. But right now, the enthusiasm is for the infrastructure.
So when it comes to the AI adjacent technology companies, if NVIDIA rises and falls, does that mean they're going down with it?
Well, it depends on why NVIDIA is rising and falling. If people back off on spending, then that's a big difference, and yes, they will fall with it. If it's backing off because it had such a huge run and people are now looking outside of it and saying, what else can I put money into that is also going to benefit from this spend? You've got memory differences that have to be used with large. There's a whole lot of other parts of the technology stack that are going to change because of this movement in having bigger servers with GPUs liquid cooling. There's an enormous amount of stuff that goes along with this. So I think that it's a little bit more about looking for the other parts of the ecosystem than it is about walking away from NVIDIA. Right now, they're still in the catbird seat. They have a position that nobody yet can rival. At some point, will there be rivals? Probably, and certainly that will start more on the lower edges than the top, but it will happen.
So do you think that this is a point, though, investors should come in and buy if they potentially weren't already in NVIDIA?
I think that very much depends on your time frame. If you have a very long time frame, absolutely. If your time frame is very short, you'd want to see where this really settles. I mean, yes, it's up today, but it's had a big move down. So I would think that it really depends exactly what you're looking for. And on the short term, I would see a little bit more how it settles before I would jump right in.
How frustrating is it to understand things like valuation in a market like this, especially at a time where right now we see stability in benchmark treasury yields, but there's a lot of uncertainty going forward, given the fact that we can't really project out how far this has to go or exactly what form this will take in? How difficult is it to have any kind of historical reference that you can bank on for a model going forward for more than just a couple months at a time?
Well, I think the very difficult thing is that right now it's not necessarily about modeling out the next 6 to 12 months because we don't know what they're going to look like. I mean, people will do that and that's their job and they will extrapolate earnings from here to there. But I think you really have to look at, okay, what's the bigger picture and where do I see the growth coming from and where do I see opportunities and what am I paying for it? So you have to think about all those things. 6 months ago, 3 months ago, NVIDIA was, relative to its cash flows and what it looked like was doing, was not that crazy expensive. And the move up has just been people going, oh, it wasn't that expensive, we should go buy some. So there's a lot of back and forth, but I think timing is important, so we try to keep an eye on that. But it is, right in this market, it is difficult.
I want to ask you that question about where the growth comes, but for the rest of this market. To Lisa's point, it has been tech the only loved thing, perhaps except for a minor blip. So if you're looking at these more cyclical stocks, you're looking at small caps at a time that we start to see the consumer maybe paring back, some of the growth metrics getting a little bit weaker. Where does the growth come for the rest of the market?
Well, there's an infrastructure build that's going along with a technology build, and that's going to be a positive for the industrial stocks. And I think, to the extent that there's been a big move in utilities, that's a longer tail because it takes a long time to permit and to add capacity on the utility side. But are we going to need more energy? Are we consuming more energy? Yes. Do I believe that the technology will bring some of that energy usage down eventually? Yes, because that's what they do. But I think that there are plenty of places where this can broaden out that are about this infrastructure. But there's also, the consumer is at the moment a little bit more stressed than it was, and the larger tech companies are not particularly financially stressed at all. So right now, that's where a lot of the big spend is going.
I'm really happy to say that you are joining us for the rest of the hour. Sarah Hunt of Alpine Saxon Woods is sticking with us right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Apple has no plans to integrate Meta's AI chatbot into its iPhones, according to people familiar. The Wall Street Journal had reported the iPhone maker was in talks with the social media company, but Bloomberg News has learned those talks didn't get very far. Sources tell us Meta approached Apple months ago, but was turned down because the iPhone maker doesn't think Meta's privacy practices are tight enough. Shares of Germany's Merck are falling in European trading. The company says it will discontinue development of a drug that was meant to treat head and neck cancer. Analysts had estimated that that drug could reach peak sales of $1.5 billion. This marks the second high-profile drug failure for Merck since December. And Airbus is missing millions of critical parts needed to make its planes. The aircraft manufacturer warning late Monday that it's experiencing a shortage of engines, aerostructures, and cabin interiors. The delays are causing the plane maker to cut back on longer-term goals in everything from its operating profit and jet handovers to monthly production of its A320 model. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I agree with you, Anne-Marie. We don't want to hear about another airplane issue, this time with Airbus.
More delays, which basically get through all of it, supply chain, whatever you want to call what the issue is. At the end of the day, it likely will mean higher airfares.
Because there are fewer planes getting delivered. It also raises this question of what kind of hangovers are there in the physical world from the pandemic that really did hamper certain supply chains. Up next, flying blind into 2025.
There's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Which is why people just buy NVIDIA. That's coming up next. You're watching Bloomberg. NVIDIA trying to claw back some of the losses, and as a result, people are feeling good, at least in the stock market, except for the Russell 2000. Once again, lagging behind once as you get tech that's actually leading. Under surveillance this morning, flying blind into 2025.
Is this going to end up being something that sort of paralyzes the investment community for a period of time? And that is a thought that I think makes a lot of sense. I think there's a bit of fog here when you think about the 2025 outlook that the election is creating, even though there's not a sense that people really know exactly what to do right now with either outcome.
Here's the latest. The U.S. election kicking into gear on Thursday with the first presidential debate, followed by the first round of French elections on Sunday. And if that wasn't enough, the U.K. election happens next week. Peter Tchir of Academy writing this. While the wild card risk is difficult to identify, there is a real sense of global unease, a lot of opportunities for troublemaking, and fewer reasons for the bad actors not to behave badly. Markets, in our assessment, are underpricing these risks. Peter joins us now. Peter, this has been the tricky thing. It's felt like this for a while. We've talked about the auctions. I've been hyper-focused on them and mocked endlessly for it. And yet we haven't ever seen the bond vigilantes come to the table and express their fear in the form of market pushback. How can you express concern in a market that can't identify risks and loses if they bet on them?
So one, I've been kind of avoiding the Treasury market as a way to express any geopolitical concerns, because normally we would get that flight to safety. But I think anytime we get geopolitical elevation, everyone gets concerned about spending, both domestically and foreign. So we've been playing it much more from the commodity markets. I think the commodity markets are underinvested. They're cheap. There's a potential for some sort of commodity shock. You know, when you look at this, you have China kind of built around all these autocratic resource-rich nations, Iran, Russia, not good countries, right? And it's all, to me, going to feed through commodities if something happens. So that's where I like to express my bets, is via the commodity market and the commodity stocks.
Peter, in your latest note, you also say, is this a one-stock market? Calling it that seems a bit extreme, but is it? To Lisa's earlier point in the show, if you're so concerned about the election risk and the geopolitical risk around the world, is the answer just so simply to buy NVIDIA?
No, I don't think so. To be honest, it's one of these, right? We talked about this, I think, just last week when I was on your program. Momentum has worked very well. Momentum kind of feeds on itself. You have these ETFs where 50 cents on the dollar basically goes to 8 or 9 stocks every time money goes into QQQ. So I think that momentum built, it's starting to fall down. I think that's why so many people are now looking at technical levels, as you mentioned, right? The 50-day moving average in NVIDIA could be in play, and that's at $98, I believe. So I think there's more room to the downside on the momentum stocks. With the way the economy is shaping up, I don't see a lot of, good certainty for other stocks. So I think we get this pullback, and to the extent we get this quote-unquote catch-up trade, it's going to be in a down market where those stocks perform less badly rather than it's some sort of trend like we had last fall where the the laggards really did well.
So, Peter, what you're seeing then over the past 3 days, $430 billion wiped out of NVIDIA. Are you saying that this is the start of a sentiment shift? Because there's plenty of arguments out there, is perhaps I need to be corrected at the start of the show, that it's just portfolio rebalancing towards the quarter end. So which is it?
I think momentum has a way of feeding on itself, right? So as it keeps going up, it forces more and more people in. It gets people stopped out. People feel they're missing the rally. People need to show, hey, I own NVIDIA. It doesn't matter what price I bought it at, or those types of stocks. And I think now that's unraveling a little bit. You start seeing that decline a little bit, right? It's, to me, the fact that you have a 2 times leveraged ETF on a single stock strikes me as completely bizarre. That shows me just how much froth there is in that, and that it's moved to me to trading like a number, right? It's not trading as a market cap. It just trades as a number and who gets in last or not. So I think there's more room to the downside. I think people are going to try and buy these dips, but I think we're not done seeing, the lows on this stock in the next month or so.
Good morning, Peter. I agree with you there, and I just wonder how you are expressing your conviction in commodities and in which direction right now, because if the rest of the market is going to catch down and you're seeing some wobbling into the China property markets and some of that other stuff, where is it that you are looking at the moment at commodities favorably?
I think mostly right now at the energy stocks. I think the energy companies, there's some good driver stories behind that anyways, right? We need some energy for all the AI that we're going to develop. That's going to get done. So energy's been my favorite place. Industrials a little bit. I do like the potential companies that could be part of rebuilding Ukraine if some sort of a truce comes around there. But in general, it's really been mostly focused around the energy space.
How long-term is your bet? I guess that's one question as we sort of look at week-to-week volatility based on a lot of headline noise. what is the appropriate amount of leeway to give yourself in order for a trade at this point?
So for me, I think one reason I'm gravitating towards energy, I like it for the next 2 or 3 years regardless. I think there's a lot of opportunity in the energy space. I think we're going to have to continue building out new sources of energy and renewable energy, but we're also going to continually have to reinvest in traditional energy sources. You see what's going on in terms of the growth in India. India is going to suck in more and more commodities into their system. So I think there's a lot of potential for that. So to me, I kind of get the geopolitical risk, not quite for free, but I feel like I get that potential bump without having to, detract from my overall thesis.
So just to sort of take a step back, overall, you're saying the geopolitical uncertainty creates a lot of questions. The question is how you want to play that, since it's very difficult to do, say, in the Treasury market. You're looking at commodities instead. You see NVIDIA as seeing more downside losses. When you zoom out, how are you arranging what your ballasts are? Is it just energy and cash? Is it energy and short-term T-bills? And then basically a cadre of energy stocks that you think are going to be most relevant? Can you give us a sense of what you're shifting overall?
So we've been shifting in and out of duration. I love the 10-year Treasury when it's above 450 and above. I really don't like it at 430 and below. So right now I'd be much more in cash in terms of where I want my fixed income. You have to keep equities. And again, I think the U.S. has probably still been the best place to be. I actually don't mind Chinese equities. I think this friction is going to create more and more opportunity for Chinese stocks. I think there's deglobalization. I think we're headed on a bad path. I would not want to invest in China long term, but I think for a trade, you can get back into those FXIs, K-Webs, and a lot of our attention right now is being focused on what's going on with the Philippines and the Second Thomas Shoal. It's kind of off everyone's radar screen, but there's more and more escalation there. And one of the real problems is we actually have a treaty to come to Philippines' aid if they have a military service person die. So what happens there when you have something that's 100 miles off the Philippine shore? China's, becoming more and more aggressive. There have been injuries now. Those are the little things that are popping up. And we're also watching, does Putin try and do something ahead of the election? Because if any global leader would seem to want Trump, it would be likely Putin. And certainly a commodity spike, anything that hurts oil, would hurt the Biden administration. So Putin might be, emboldened to try something over the summer.
Peter, in the same breath, you said you're going into Chinese equities, but you're concerned deeply about the geopolitical risk around the Philippines and China. So what's your timeline for being a traveler in China?
I think for the next 3, 6 months, maybe even a year, I think part of our thesis has been this made by China, where China is trying to sell their brands globally. They're not going to have immense amount of success in the U.S., though maybe that I'm even underestimating as places like Tumu continue to take off. But you look what they're doing with their EVs. They're trying to sell those globally, right? Our view has been China has these autocratic, resource-rich nations where China generally has trade deficits because they've been buying their commodities. We think they're going to start selling more and more of their brands into that. So that will actually be good for the Chinese companies, as they kind of become global brands. I don't like it. It's not necessarily where I think we should go as a nation, and we should probably have to do more to defend that. But that's how I see that playing out. So I think if we get any sort of economic turnaround in China, it's going to benefit Chinese companies much more than global companies, unlike the past, 2 decades.
Peter Tchir of Academy, thank you so much. Enjoy London. Have a great vacation. We'll see you on the other side. Saira Hunt's still with us. How much do you agree with that? Buy Chinese stocks because the idea of trying to sell to the rest of the world will gain traction on some level.
I think that there is a trade in there for certain. We definitely tend to stay much more on the U.S. markets than we do on the foreign markets. I think to the point that the deglobalization is problematic in terms of the kind of growth that historically would ramp up the rest of the world, which is a point that he was making towards the end there, that a big amount of Chinese growth has usually been good for the rest of the world. And if you are starting to see a bifurcation where you've got a bunch of countries that are working together and trying to sell into those markets and not so much the cooperation that we've seen between the OECD and China, I think that's part of the reason that there's an inflationary forces that are even without some of the current things that we've seen now, and one of that is deglobalization.
So in other words, you're not convinced on Chinese stocks?
Not right here.
I'm just trying to put it together because this is some of the aspects that people are looking at. Coming up, NVIDIA looking to bounce back after erasing $430 billion in market value over 3 days. We're going to be speaking with Bloomberg's Mandeep Singh coming up next to talk about Danny's point, which is essentially, isn't this a sign of resilience? Because A, it's bouncing back, and B, other stocks took up where it left off. trying to claw back some of the $430 billion of market losses over 3 days for NVIDIA, and bringing the rest of the market with us. Good morning. Welcome back. This is Bloomberg Surveillance, taking a look at stocks edging higher, led by the tech shares. NASDAQ 100 futures up 0.4%, a reversal where the NASDAQ had really lagged behind. S&P futures up 0.2%. Russell 2000 struggling to get above red, which really is a reversal again based on the outperformance. Raises a question: how much do we really care about this? And I say this not as somebody who's losing or gaining a lot of money, but Danny, to your point, how much is this just sort of technical rebalancing that everyone is making a big deal about because there's no certainty to talk about anything anywhere else?
Well, that seemed to be the move to me because it was so sudden, no clear catalyst. But you listen to Peter Tchir, who says this thing can continue, that if we're getting momentum that's flipping, if you have these strange ETFs where you can 2 times leveraged NVIDIA, if sentiment is turning, it will turn hard and it will continue.
In the meantime, it seems like there is sort of an uneasy calm under the surface. And when I say under the surface, I'm talking about the bond market. Take a look at 2s, 10s, and 30s. You can see that stability. And I say stability because if you look at a graph looking at the past 5 days, it has barely moved. And when that's really a shocker, considering some of the volatility, some of the gyrations that we've seen so far year to date. 2-year yields 4.73, 10-year 4.23, 30-year 4.36. That all could change with one auction. And that's really why I'm watching the $69 billion in 2-year notes being auctioned off at 1 p.m. Saira Hunt still with us. Saira, how much are the auctions instructive at a time of relative stability where why bother betting big on treasuries if they're just going to whipsaw around and end up at the same place anyway?
I think the auctions don't matter until they matter, and they only matter if something goes wrong or if it looks like there isn't enough demand for U.S. Treasuries, because we are refunding so much and that deficit is continuing to go up, even in an economy that's not terrible. So I think to the extent that people only worry about it when it starts to look like there's a problem and all of a sudden that's going to change yields, then it becomes an issue. When they go well, people don't notice as much because it's not a problem. It's only when they go, oh my goodness, there's a problem with demand on the Treasury side. We have a lot of Treasuries that need to be sold. So then it becomes an issue.
And that's the reason why people watch them and then they're non-events, and then people say, why do we even watch them? And then they watch them anyway. Meanwhile, you transfer this through the currency space, the foreign exchange space, as we await what's going to happen in France. You can see a marginally weaker euro, but some stability there as you have a number of people saying, go into French bonds, go into French debt, go into this idea that maybe some of this is overblown. I'm thinking of Bank of America in particular, which brings us to under surveillance this morning. Marine Le Pen's far-right party widening its lead ahead of that first round of French elections this weekend. Le Pen's party rising to 35.4% in Bloomberg's poll of polls, ahead of the leftist alliance, with Emmanuel Macron's party in third. Emery, this to me is fascinating because even if Marine Le Pen's party wins, still unclear what that actually means for policy.
That's right, because you're going to have basically a split and divided government. But you can see Macron is clearly nervous. Yesterday, he came out talking about how whether it's the right or the left, their policies are invoking a civil war. But all of this rhetoric he's been talking about hasn't fended off what we've seen, which is them just continue to rise, whether it's the right or the coalition of the left, continue to rise in the polls. You mentioned Bank of America saying go in. Allianz last night is actually saying that these French officials need to come out and reinsure investors, especially foreign investors, given the share foreign investors have in the French bond market, that there's not going to be a euro crisis, because any woof of what we saw in the past when it comes to the sovereign debt crisis in Europe, that is going to spark fear.
French officials are trying to do that. Marine Le Pen's party is trying to do that. We had her right-hand man, Jordan Bardella, come out and say, look, we're going to be reasonable with this budget if you elect us into office. We will bring the deficit back in line with what the EU wants. There is this feeling that Liz Truss changed everything, that everyone looked at what happened to her and said, okay, she essentially got kicked out by the bond market. This is a real threat. We need to come in and we can't shake the boat too much. I mean, we saw it with Meloni. Meloni, before she was elected, had these much more far-right economic policies. She gets into office and she moderates. So that might be what we're witnessing with France, too.
The ghost of the Liz Truss moment hovers and disciplines all. Meanwhile, shares of Airbus tumbling, the plane market cutting its outlook amid a shortage of parts caused by supply chain constraints. Meanwhile, Boeing's bid for Spirit Aerosystems will value the supply at around $35 per share, about a 6% premium to Spirit's stock price. All right, so we knew that Boeing was going to buy Spirit. The more interesting story to me, Danny, is really this question around, we've bashed Boeing, we've dragged it in the mud, we've talked about how it's this, really troubled plane maker, Airbus, the gold standard, and then this.
I mean, it just shows that the pain is going to be here for some time. Guillaume Faury said something like it'll be 3 to 4 years until the supply chain is back to normal. Great. So we can't fly on a Boeing because we're all scared. We can't fly on an Airbus because there aren't enough on there. We're all just going to be on older planes, which means more fixes, more delays. It is the summer of discontent, Lisa.
But Saira, to this point, how much are we not seeing the full effects yet of just how much industrial areas were really disrupted by retirements, by people leaving the workforce during the pandemic, not to have returned, especially with their expertise, at a time where we're depending on the physical world to continue to support some of the technological advances?
I think it's absolutely an issue. And I think that, like everything else where there are long lags, people don't think about how long that can take to resolve itself. And if you had a long period of time where the factories weren't running properly, machines need to be restarted, everything needs to go back to where you were, and there's going to be some slippage in there, and you're seeing that now with Airbus. And it's interesting that you're seeing it now as opposed to 6 months ago. You would think that there would have been an eye to the supply chain a little bit earlier, but this is also where we got so used to just-in-time inventory that when you take something and throw that out of whack, I don't think people realize the ramifications and how long that was going to take. And not only are they going to be more expensive, but those planes are going to be absolutely full. Having just flown yesterday and the day before on 4 flights that were absolutely full, I think that we can just continue to look forward to that.
Well, and this actually raises issues also about some of the disruptions that we see in the Red Sea going forward. What kind of further other kinks could you get to the system? I don't want to think about it. Meanwhile, I do want to think about NVIDIA because that's evidently what all people can think about. Shares of NVIDIA rising in the pre-market after a 3-day slump that wiped out about $430 billion in market capitalization. That's the biggest 3-day value loss of any company in history, and saw NVIDIA's market cap dip below $3 trillion under both Microsoft and Apple. Mandeep Singh of Bloomberg Intelligence joining us now. You know, Peter Tchir saying it's just a number really resonated with me. At this point, it just sort of monopoly money because it's hard to sort of imagine the idea of the gain or loss of a Johnson & Johnson or a Bank of America in a couple of trading days. As hard as it is to imagine $1 trillion of market capitalization created in just a couple of months. So at what point can you put any credence on these moves other than just technical rebalancing?
So you're right. Nothing has changed fundamentally to validate these kind of moves. But, you know, at the end of the day, this is a stock that's trading at 40 times price to sales. It's the largest market cap company, or it was a couple of days back. And you have to ask yourself, how long can it sustain that path? Because everyone is excited about the prospect of AI. That's why they had 126% growth last year. And look, I think everyone realizes this is not sustainable. But in the end, it comes down to when are they going to really slow down? And that's where you have to look at the different moving parts, whether it's the cloud service providers' CapEx spending, or the end market demands from the software guys, or even Apple jumping into AI. Now that they have a large language model, are they going to invest in AI and, you know, ramp up the CapEx spending the way other hyperscalers have done? So these are the unknown questions that's going to drive the momentum. But that's what market is grappling with right now.
I mean, something very similar that Saira was talking about, this idea of everyone is, I mean, it's consensus at this point that NVIDIA is overvalued, but also consensus is this is a rock star of a company that has huge transformational changes. So what could bring it back down to earth? Is it in earnings? Is it competition? Is there any really clear threat at this moment?
Yeah, so if you look at it historically, whenever we had a chip wave, for every $1 in chip revenue, you generate $4 in software revenue and probably $6 to $7 in services revenue. What the market is waiting for is, look, we've spent almost $100 billion in data center GPUs last year. Has that translated into software revenue of $200 to $300 billion, another $300 to $400 billion in services revenue? If it hasn't, will there be a pause? Will there be a digestion to figure out when does it translate into software revenue? Because the semi companies always see that demand early. That's been the case always. What's different is NVIDIA having mid 70% gross margins. So that's where, is it really different this time, or the value going to accrete to the software guys, and, you know, the services guys will have the services to show. So that's what market is waiting for.
So when will we find out?
Well, so I think this quarter earnings will be a good kind of reflection of where we are in terms of the software monetization. Everyone is talking about copilots. the fact that GitHub Copilot is successful, chatbots, customer service chatbots. So there are some tangible use cases that everyone recognizes. It's just how does it translate into revenue? Adobe gave us a data point where they did beat expectations. Salesforce didn't. They talked about high single-digit growth, going forward. So clearly there is a divergence in terms of how these companies are looking at AI contribution. And in the end, it comes down to hyperscalers. That's where all the AI capacity is getting deployed. If the hyperscalers see an acceleration in their cloud revenue, that's when you know this is going to translate into revenue near term.
Mandeep Singh of Bloomberg, thank you so much for being with us, as always, and for the insights. Saira, I'm curious from your perspective, how much the idea of U.S. exceptionalism is tied up in this idea of AI adoption. Is that really what's been fueling the divergence between the U.S. and the rest of the world's economy?
I think it's the AI boom, but I also think it's technology in general. The U.S. has been much more of a juggernaut on technology than some of the other countries. It doesn't mean that there aren't places in those countries, but it's not the infrastructure in the U.S. and what's gone on in the technology sector. A lot of that innovation has come from here. When people talk about exceptionalism, I think part of it is the things that have been built on the technology side.
So it's AI, everything that is adjacent to it. If it's not in the United States, who else can benefit from this?
Well, the areas where you've got people that are making companies like ASML and TSMC, right? The companies that are in this infrastructure. But if you think about the Googles that have been built and Metas that have been built, all of that, and Amazon, all of that was built in the U.S. So it's not just AI, it's that whole technology stack that people have gone, again, you start out with something at Amazon and you go, I'm not sure where it's going to end up. Nobody, when it first started, thought it was going to end up a web hosting, the major web hosting company. But there's that change there and there's that continuous innovation. And I think that is something that tends to be centered more in the U.S. than outside of it.
You have this infrastructure in the U.S., but Saira, I am struck that this is coinciding with the whole onshoring, friendshoring kind of thing, that you want to have your AI infrastructure and you want to have it closer to home. So could one make the argument Europe's going to have to catch up at some point? Europe also is going to need the infrastructure closer to home. I know Apollo and Intel partnered to build something in Ireland, that trend's going to have to continue.
I think this is part of the issue. What is inflationary about regionalization and a lack of globalization is that you have to add capacity in places where before you were like, well, globally there's enough capacity to do this, so I'm not that worried about it. Now, because of the things, and Airbus is a great example, because there's something where that supply chain was global, and now you're seeing the problems that has when you have a major disruption. So that isn't in and of itself is not deflationary, it's inflationary because you're adding to costs by doing that. So that's part of the tension that we're seeing with all the things that are going on right now. And how do you rein back inflationary pressures when they're not just about too much money chasing too many goods?
I just wonder, as everyone talks about the physical world and creating all this stuff and the industrialization, are younger people going to be able to do some of the skills that require actual physical work other than just looking at a phone? I know this is crazy, but I just wonder about what kind of training there is. I don't know. Does anyone talk about that ever?
Well, I will tell you that the person who does talk about it the most is Nick Pinchuk, who's the CEO of Snap-on, because they've actually had to create an innovation center locally for them because they can't get people who have the trade skills to do the things that they need to do actual physical work. So there's going to be a question about how that plays a role. And right now we went so far to the other side of that I think you're starting to realize that that's a problem.
Thank you so much. It just is my internal concern based on home side issues. Meanwhile, let's get an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackis. Yahaira.
Hi, Lisa. Novo Nordisk plans to invest $4.1 billion into another U.S. factory as it plows more money into its biggest market. Novo saying the project will double its production footprint in the U.S. and add 1,000 jobs. The new site is the latest multi-billion-dollar investment by the Ozempic maker, with the company saying it plans to pour $6.8 billion into production investments this year. That's up from $3.9 billion in 2023. The nearly 15-year battle over the prosecution of Julian Assange may finally be coming to an end. The WikiLeaks co-founder is expected to plead guilty on Wednesday to leaking U.S. national security secrets. Assange was accused of publishing sensitive U.S. military documents back in 2010 and 2011 in one of the largest breaches of state secrets in U.S. history. The plea deal would allow Assange to avoid prison in the U.S. and return to his native Australia. And the Florida Panthers have won their first ever Stanley Cup. defeating the Edmonton Oilers. The Panthers had taken a 3-0 lead in the best-of-7 series, only for Edmonton to win the next 3, forcing a deciding Game 7. Both sides scored in the first period, but a second period goal for Florida was enough for them to seal victory and the championship. Despite being on the losing side, Edmonton superstar Connor McDavid was named the series MVP. That's your Bloomberg Brief. Lisa?
Thank you so much, Saira. Up next, waiting for the inflection point.
So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
That's coming up next. Mary Daly with some really interesting comments. This is Bloomberg. Well, coming into a day trying to gain after 3 days of losses on NVIDIA. Welcome back. This is Bloomberg Surveillance. Under surveillance this morning, waiting for the inflection point.
Both supply and demand factors have contributed to the reduction in inflation, and we've done all of this without a big disruption in the labor market. When I put all this together, I think monetary policy is working, but there's still more work to do. So far, the adjustments in the labor market have been modest, not really pushing up the unemployment rate. But we're getting nearer to a point where the outcomes on employment may be less benign.
Here's the latest. Investors looking ahead to another read on the U.S. economy with consumer confidence data due at 10 a.m. Eastern. Plus, more Fed speak today from Michelle Bowman and Lisa Cook. Nick Bennenbroek of Wells Fargo writing this. Recent U.S. inflation news has been more encouraging, likely keeping the Fed on track to start cutting rates in September. Against this backdrop, U.S. dollar strength could persist for now through late 2024. Nick joins us now. Nick, good morning. Welcome. Thank you so much for being here. I want to start with Mary Daly's point of the San Francisco Fed. She's talking about how at this point is when you might start to see a nonlinear increase in unemployment. Is that something on your radar in terms of a real risk, or is this more interesting in terms of where the bias may be on the Fed?
Probably the latter, the bias on the Federal Reserve. I mean, it's fair to say that, when you look at a lot of the leading indicators, job openings, we could start to see a slightly accelerated increase in the unemployment rate. But overall, if you look at the consumer fundamentals, we're not that worried about a recession of any kind. And therefore, we're not really worried about the unemployment rate spiking.
So if we do have Mary Daly changing her language, and it is more interesting from just a Fed perspective, do you think that she's potentially not alone in this? That if the Fed is starting to get concerned about a shift in the labor market, that it's not just vacancies that aren't filled, but it's actual layoffs, a cut could be coming sooner?
I don't know about sooner. I mean, what I would say, though, is if you looked at the early part of the year, there was a lot of frustration on the part of the Federal Reserve, those inflation numbers that really weren't helping out. Now the labour market's kind of improved. We're seeing some softening in the labour market, which helps from that inflation perspective. But I think more importantly, inflation has started to cooperate. And so at that point, we're still comfortable with the idea that, yes, we're in September. We were thinking maybe we'd get pushed back to December. We're holding steady at September.
I think that the CPI numbers last week were part of that ability to look at September again, because the employment stuff looked so strong the week before. But if I think about the idea of, cutting ahead of time because you don't want to be behind the curve, and where does that sit right now? Because it does seem like that labor market is getting a little bit softer, and sometimes that goes from a short softening that can spiral pretty quickly. So how are you thinking about that and how that works for the Fed? And what does 25 basis points do for that?
Well, I would say 25 basis points. I mean, it probably doesn't do a lot, but you have to start somewhere, I suppose. I do think that's part of the calculus. I mean, I believe the Federal Reserve policymakers, they were certainly scarred, shall we say, by the experience of the pandemic and the way that inflation got away on them. But they are looking at the softening in the jobless claims, for example, the job openings, and the real Fed funds rate is extremely high now, sort of 5.5 relative to sort of 2.5, 3% on the PCE. So from that perspective, even though they're not quite at their inflation target, they are probably at the back of their minds worrying about that more excessive slowdown and thinking, yes, we need to start moving ahead of time.
Which is the reason why you see September as a feasible date to start cutting rates, and yet you still expect dollar strength. Is this because of this expectation that the Fed's not going to cut as much as the ECB, or is it actually independent of any central bank and just simply the U.S. is less dysfunctional right now, at the moment, at least the appearance of it, than, say, France?
Yeah, I mean, I think a little bit of that political uncertainty in France is holding the euro back for the time being. But, and to be fair, I think our main story is maybe a little bit more dollar strength through until the end of late 2024. We think the dollar weakness, though, is likely to most transpire when we see the Federal Reserve start to cut rates and when we see the US economy slow down the most significantly and the most clearly. We're only seeing hints of a US slowdown at this particular point in time. And so while the US rates remain high and while the US is still sort of moving forward, that's kind of probably going to keep the dollar on the front foot for the time being. But I think the longer term trend, as we see US softness, as we see US rate cuts, 2025 is probably more a dollar weakness story.
When you look at France, what do you make of what's going on with the bond market in the sense that Zurich Insurance says we're not going back to that place we were? This new spread we have between French bonds and German bunds, that's here to stay. Would you say then this is an area you should avoid, or do you not think it's going to be as bad as some are maybe fear-mongering and it's time to get in?
Yeah, I mean, I think on that perspective, I would probably be in the camp that says it's not going to be quite as bad as feared or worried about. I think that spread is currently 75 basis points between French and German bonds. And I think a lot of the bad news is priced in. Now, we know France isn't Mexico or South Africa, but they had elections there recently as well. There was a lot of concern immediately after the elections that policy would move in an unfavourable direction, but some of the fears have calmed down. I think with the French election, so long as we don't sort of see an absolute majority by, say, the National Rally or one of the opposition parties, I think that most of the bad news is probably priced in. I wouldn't be surprised if we saw that spread narrow a little bit. Maybe not all the way back to the 50 basis points, but I think we can get into, say, 70 and 60 basis points. I think at the end of the day, it's not going to end up quite as bad as we think.
Nick Bennenbroek of Wells Fargo, thank you so much for being with us and for your thoughts. Saira Hunt, we've got a couple minutes with you. Thank you so much for spending the hour with us. I want to start with just the idea of, are we really playing this game of who's the most dysfunctional political house in the world, and then just sort of going to the other side of the boat until tensions calm down?
Unfortunately, I think we are playing a game of where is the least bad, right? And this has been the story for so long about currencies. It's been the story about markets, almost since the financial crisis. It's like, where is it the least bad? Let's go there. And I think that is part of the issue. And you look at the political calendar globally, and it's difficult. I mean, we're finally starting to focus on the U.S. election. We'll see what happens this week. But people really haven't been focusing on it because it's out there. And now all of that is coming and coalescing. And I think that that's one of the reasons that we feel that this summer is going to be a lot of push-pull on the markets. There's no direction. And this is part of why people are having trouble finding conviction in a trade at the moment, because there's so much out there that's unknown. And I think that, to the extent that you want to be in the least dirty part of the whatever, it's just, that's not a good thing, right? But it's the way that it is. And that's what we all have to contend with.
If November 5th is a coin toss, though, which the polls show it is, how do you trade this summer? How do you prepare at all for that?
Well, even the discussions about what would be worse about a Trump presidency versus a Biden presidency on the tariff side, I think there's a lot of rhetoric, and the question is what would actually get done. And in the end, there was a lot of discussion when Biden won that he was going to change some of the policies that were there, and they didn't really change. So I think that there's a lot of discussion that happens, and then you get on the ground and you realize that there's only so much you can do without the potential of throwing things off too far kilter. And I don't think any politician wants to do that, because nobody wants to throw the U.S. into a recession.
Saira Hunt, thank you so much for being with us and for spending this time with us. Saira Hunt of Alpine Saxon Woods, with a real insight into a world in turmoil. Danny, I'm struck by when we're hearing about Sarah's talking about sort of this, or implying this paralysis almost. How can you get ahead of some of these elections when it's staring into an abyss? Which raises the issue of some of the technical discussions that you're talking about, because it's sort of dancing on the head of a pin.
And it's also just this environment of where do you go that is safe right now? I mean, the least dirty shirt in the laundry, I guess, is NVIDIA, I guess, is tech. But what happens when you face an environment like this week where it's not safe? Where do you go? Can you go to duration? Maybe not, because we're worried about the deficit. We're worried about auctions. You're just kind of stuck in this no man's land that I think maybe just brings us back to cash? I'm not really sure.
Well, we'll get some insight on just those questions coming up next. Morgan Stanley's Mike Wilson, Bloomberg's Benedikt, Kammel, and Greg Peters of PGIM Fixed Income. Right now, markets trying to stage a rebound after 3 days of losses on NVIDIA, although not dragging down markets as much as you might think over those 3 days. Today, pushing up markets higher with S&P futures up 0.2%, yields pretty much stasis, 422, down a basis point.
This is a fairly complex market. Like I say, highly concentrated and yet very high dispersion. It means it's a stock picker's delight.
Everything looks calm on the surface. You have to look to the single stocks for the drama.
The market is becoming more discerning in where it's allocating capital.
We've been talking about mega cap growth the last few weeks. It just feels like these stocks are tired. Like it just feels like they're sort of on their last leg.
The tech gains are quite fundamental. I think they actually create their own demand. At some point, that party will stop.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Welcome back. This is Bloomberg Surveillance from New York City for our audience worldwide. Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. Jonathan Ferro will be back later this week. We are talking extensively about NVIDIA because it has been NVIDIA's world. We have been living in it. It gained more than $2 trillion of market valuation in less than 12 months. And then, like that, in 3 days, it lost $430 billion. And Danny, the question really is, how much does that matter over long-term fragility and sort of being leveraged to one stock and one stock alone?
It does show vulnerability of this market, but I don't think it yet shows a narrative change. This is still such a loved company. You can even see it in the discussion we had for the past hour. What else can you buy right now?
Which really is because we're looking at a political backdrop that, as Lori Calvasina said, is like staring into the sun. We are looking at elections around the world, accounting for about 50% of global GDP in terms of potential political shifts. How do you get ahead of real sea changes in policy that have been the bedrock of a lot of bets made in the market?
Well, in the last hour, my big takeaway from Peter Tchir and Saira Hunt was no one's going to fault you from owning NVIDIA. And if you're so concerned about the U.S. election, and it's what Lori Calvasina is talking about, staring into the sun, and now you have this period basically of paralysis and angstiness this summer, then maybe you want to stay on the sidelines and only just buy NVIDIA on dips like we saw yesterday.
Which is sort of a difficult thing on a moment when people are saying it's time for active management. I do want to get right to our guests because we've got some wonderful guests coming up. And right now in markets, we do see a little bit of a lift, but really calm. What I've really struck by over the past couple of days, as Danny pointed out, and she's really right to do so, this idea that we haven't seen a massive rout in tandem with NVIDIA. Other shares have been offsetting it. You pointed that out. You're seeing that again today. S&P futures up 0.2%, even with NVIDIA up some, 3.5%. It speaks to almost a resilience, a stability under the hood.
It does. We have gone through over a year now with a less than 2% decline. I mean, there have been longer stretches, but it does show even if NVIDIA drops the most by any stock has ever done in market cap over the past 3 days, just a rotation happened over the surface. Sure, it's not lasting today, but there is some form of resilience in this market.
It's almost like the cylinders are just offsetting each other in tandem. What you can see is a little bit of dollar strength versus the euro, but kind of more abound in this range of 107.23. And you could see real stasis in the yield space, which I find fascinating given some of the fluctuations that we've seen over recent months. Coming up this hour, Mike Wilson of Morgan Stanley saying growth right now is more important than inflation, echoing a bit of what Mary Daly was saying. Bloomberg's Benedikt Kammel on new worries for plane makers. And Greg Peters of PGIM Fixed Income saying it's still time to take on risk, but with a real eye toward the uncertainty in the political sphere. We begin with our top story. NVIDIA is looking to bounce back from a $430 billion slump. Mike Wilson of Morgan Stanley expecting narrow market performance to continue, writing this. We continue to recommend a barbell of large cap quality growth with defensives while fading lower quality cyclicals and avoiding the temptation to play for a true broadening out. Today is a good example of that, Mike, given the fact that we are not seeing the Russell 2000 participate in today's enthusiasm. Mike, wonderful to speak with you. Really appreciate it. You've been talking about this for a while, that it's not necessarily this all boats are going to be lifted by this AI enthusiasm. What's your takeaway from the volatility in NVIDIA shares? And to Danny's point, the idea that we have not seen it broaden out to some sort of contagion or real market weakness.
Yeah, well, look, I mean, I think the market's pretty smart, as usual. It's figured out exactly what's going on. We go back to, I think, probably our main narrative, which is probably not consensus yet, which is that this policy mix that we've had is very unusual, right? We had this incredibly strong fiscal policy, which is keeping pressure on the Fed to keep rates higher. We know rates are too high because the yield curve has been inverted. So that is sort of hollowing out or crowding out a good part of the economy and stocks. And so what does the market do? It gravitates to these lifeboats that can actually perform in this very challenging economic environment for most operators. When I say most operators, I'm talking about consumers and corporate. And that's reflected in the data, right? And it's not just the Mag 7, by the way, that's high quality growth. There are some really good high quality growth stocks outside of tech and comm services that have been performing well. And I think you said earlier, this sort of almost like pistons moving around. The VIX is really low and volatility in the S&P 500 is low, but the volatility under the surface is enormous. And so, because it's sort of like the boat that's tilting back and forth. The people are running to different sides of the boat can actually remain fairly stable. And that's what we have going on until there's probably going to be some sort of shock. Maybe it's the elections. And by the way, the elections don't have to be necessarily worried about bad outcome. It's just higher volatility for the broader averages. Like, elections have consequences. And we're seeing that all around the world now. Why is our election going to be any different? When I say consequences, I mean consequences for obviously the economy and for policy, but also consequences for volatility in the marketplace.
So before we get to the elections, and we'll talk more extensively about that in a bit, I do want to talk about the idea of a shock. And you laid out 3 different potential shocks in your recent research, talking about the potential for upside acceleration in inflation. You say nobody's really counting on that, neither do you. Then you talk about some sort of liquidity shock. You talk about the Treasury auctions and some sort of issue with market functioning. And then you talk about what you see as the most likely, which you just flicked at, which is this idea of growth. Right. And that potentially you could see a real fall off in growth, which was kind of what we heard from Mary Daly. What are the signs that we're getting closer to that? And when do you sort of throw in the towel and that being a near-term kind of reality if we don't see more material weakening?
Well, the market is already leaning in that direction, right? It's saying that growth is probably going to disappoint. By the way, growth has disappointed this year. Most of the economic surprises have come on the downside. That continues to be the case, which is why that upside case is probably less likely. So how has the market dealt with that? Well, it's gone to large cap, quality growth and some defensiveness, which is very typical in a late cycle economy. The reason we bring this up is because the market's priced for a soft landing, and that is sort of the base case consensus view. That's all well and good. The problem with that is that, let's say it happens, well, where's your there's a lot of upside, which means you got to pick stocks. And so that's what the market's doing. It's doing the best it can in that sort of a setup. So what's the key trigger going to be for us to say, okay, that growth is turning into a real growth scare or potentially recession fear? It's the labor market, right? The labor market, if the labor market breaks down, by the way, that's what the Fed's looking at too. So if we were to see a non-farm payroll number under 100,000, unemployment go to 4.3, 4.4, you better believe the Fed's going to probably cut rates. The market's probably not going to love that initially, unless they cut 100. 25 basis points into a real growth slowdown, the market will correct probably 10% on that sort of an announcement.
I was going to say, usually the argument of, stocks can survive is because if they cut, then they get some support. But to your point, it needs to be some cut sort of in size. So if we kind of take a step back and say, all right, NVIDIA, clearly there's a lot of valuation here that shouldn't be baked in, that has been multiple expansion. If you just strip that out, does the rest of the market make sense to you, where we are with everything else? Well,
I mean, like I said earlier, the market makes perfect sense. It's paying up for quality, and it's paying up for growth that is, idiosyncratic from the economy, and maybe some defensive properties. Okay, great. So I think the market totally makes sense. The question is, are those multiples now in those particular stocks too high? I think if you get a perfect, soft landing on this plane, it could be fine. If you get any aberration from that, it's going to be a problem. And that's why we wrote about it this week, which is there's these 3 risks. Could inflation pick up again? Could there be a term premium spike because of the fiscal unsustainability? Or could there be a growth slowdown? Of the 3 doors, to put it in Monty Hall terms, I'd take door 3 as the highest risk today. Okay, that could change. And this is another lesson from the last year and a half. I mean, how many times have we changed the narrative in the last 18 months? We've gone from hard landing, soft landing, no landing. I mean, it's like, musical chairs. So right now it's soft landing. Great. As long as that remains stable, we can kind of stay in this sort of environment that we're in. But we have to be, as macro investors and traders, we have to understand these are the risks.
But there's an irony in it, which you already pointed out, is that underneath the surface, you are getting these big moves in stocks. You talked about going from one side of the boat to the other. The other way it's expressed that stocks is just correlation has broken down between individual stocks. And it's not even just an AI thing, because within sectors, stocks are no longer correlated. Is that a troubling turn? Is it a problem that that's happening? Do we need to completely rethink how we judge sectors and how stocks should be moving together?
Well, it definitely affects the latter part of your comment, meaning the idea that you're going to trade sectors is out. Okay, that's not working. So that relative value trade, which is what we kind of made our career, trading relative value in sectors, is not working really well. What's working is factor trading, which is why we're going back to things like quality, defensiveness, large cap over small. That's working really well. Operational efficiency. These are the factors that are working, which is more idiosyncratic. By the way, the breadth in the market today on a 1 month rolling basis is the lowest we've seen since 1965. Okay, that's even older than me. Okay, that's bad, and that's old. So, I mean, that's a long time. It doesn't mean it's necessarily the end of the world. We have many examples where breadth got really narrow and then it broadened out again. But typically it requires some sort of a regime shift, right? In other words, if we stay in the soft landing narrative, nothing's going to change. If we move to a higher growth, higher inflation, it's definitely going to shift probably more towards cyclicals. If we go into a growth scare or even recession fear again, that's going to be a rotation into defensiveness. So, you know, we're open for anything because that's our job. We have to be prepared for that.
If we do see a reacceleration of inflation, where would it be coming from?
Well, I think commodities could pick up. I mean, there's this talk of maybe China's going to re-stimulate again, so maybe commodities could seep back into it. I don't think it's going to come from housing. I don't think it's going to come from, you know, this owner equivalent rent. I think that's probably on the downside. Maybe it's in services, you know, services inflation. We saw that in the insurance market, things like that. But we're not looking at a groundswell of inflation like we saw in 2020, 21, because I don't anticipate this same, you know, impetus from, say, fiscal stimulus really driving the bus in the way that it did in 2021. We need an exogenous shock to get growth to drive kind of a broader inflation. That's why that's sort of number 3 on our list of things that will upset the apple cart right now.
I'm thinking about liquidity right now as your second risk, this idea of treasuries and some of the auctions and what could happen if you get higher yields. But on a broader level, this idea of the lifeboats. Mm-hmm. And the lack of diversity, the sort of lack of breadth in the market, as you say, going back to 1965. At what point does that make the market more fragile, not less, right, given the fact that if you have a true downturn, at some point you have to imagine these lifeboats are going to feel it too. It isn't just going to affect everything else that, frankly, in some places have been actually signaling some warning signs about what's ahead.
Sure, and look, all year we've seen one by one some of these lifeboats, you know, sink. I mean, and then, or they at least take on water. So that's normal too. Is that, you know, eventually everybody goes to that one boat and then it gets too crowded and it sinks and they jump to the next one. So everything that's going on makes perfect sense in the context of a late cycle economy. That's why we haven't changed our view on that. Like, we don't think it's mid-cycle or this is the beginning of some new expansion. This is classic late cycle behavior, just like 2019 or 2016, 17. I mean, this is exactly what tends to happen. I expect more of the same. And look, once again, I think it's really critical to make this statement again, which is that it's not just tech stocks. Okay, there are plenty of it's like almost like the Nifty 50, right? There's like Nifty 50 stocks that are really people are gravitating to, and they're even more expensive than some of these tech names.
Well, but I guess what I'm trying to get at is, are you going into those names too, or are you steering clear of them because of concentration risk and the idea that one of them could sink and that could become really problematic? Well,
right now, I mean, we're with everybody else because I think that's what, you know, it's a momentum market. Now, I think where we're different than other people is we're saying this isn't stable. To your question earlier, it is fragile. So you just have to understand that. And look, these are liquid stocks, so you could, if you're running a portfolio, you don't want to be, you know, doubly overweight some of this stuff, but you need to be leaning in that direction, understanding that you're going to have to move it around in the short term. And if there's a shock, and I think once again that third door is the biggest shock to these Nifty 50 names, meaning a growth scare. A growth scare / recession concern is the one that will take them all down together. That's not a risk today. But that's the one that we're kind of looking at as potential risk in the third and fourth quarter to come back into the marketplace.
Mike, as you're talking about these different lifeboats and some taking on water and maybe less of them out there, I'm kind of reminded of this conversation I had with Pete Stavros from KKR, just the fact that public markets have been shrinking. Since 95, I think, which was the peak in how many public companies we have, there 40% less. Is there some degree where there's just less lifeboats because there are less companies, that some of the really good companies out there, the OpenAIs of the world, what have you, just aren't public anymore?
Well, I think what's happened is, you know, because of maybe the AI narrative in particular, we've seen people perceive certain boats as lifeboats when in fact they got holes in them. Okay, so like that's a mistake. I think there's been a rising tide in many cases that has taken a lot of stocks up probably incorrectly. So those are the names that we're talking to clients about right now. We're saying, okay, there's sort of the AI winners, and then there's the AI pretenders. Okay, there are many companies that are talking about AI. They mention AI, the stock goes up like 2 multiple turns. Like, okay, I mean, those are the things I think you need to be more worried about than buying the true AI winners and saying, well, this actually has a business plan or a potential beneficiary, whether it's an enabler or an adopter. And by the way, just to make it clear, we're more interested in the adopters now than we are. The enabler trend has sort of played out. That's gotten priced. So you got to be a little careful. Now it's about who's going to take advantage of this technology to make a better mousetrap, a better business model to win competitive battles with their competition.
You want to tell us any of those names?
Sure. We've written reports about this. So I mean, if clients can draw them down, but we have baskets and everything else. I mean, we publish this every week.
Mike Wilson of Morgan Stanley sticking with us. Thank you so much for being with us. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Nike is betting on pricey Air Jordans to win over Chinese shoppers. The athletics giant is launching a fresh push for the Jordan brand in the region, where it has lost ground due to a struggling economy and rising nationalism. But with the launch of limited edition sneakers and splashy campaigns, Nike is hoping to lay the foundation for a permanent comeback in one of luxury's most key markets. 3 states are set to hold down ballot primaries for seats in Congress today. Congresswoman Lauren Boebert of Colorado is seeking re-election after changing to a new district across the state. In New York, Representative Jamal Bowman faces a challenge from Westchester County Executive George Latimer. And in Utah, several Republicans are vying for the nomination to replace retiring Senator Mitt Romney. And U.S. travelers continue to fly at record numbers. The TSA broke a new level over the weekend, screening nearly 3 million travelers on Sunday alone. TSA expects to break that record again this Friday as people travel for the July 4th holiday. They expect 32 million people will fly between this Thursday and Monday, July 8th. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. If only they can find the planes. Up next, investors prepare for the Biden and Trump rematch.
The point is that it's a close election. It can go any way. But you can just look at history to get some sense of how the market has behaved.
That's coming up next. This is Bloomberg. Staring into the sun, that has been the political scene for quite a while. We're going to dissect all of that, given the fact that you have elections across the world. 70%, I believe, of the world's population are going to be going to the polls in the next 12 months. Under surveillance this morning, investors prepping for the U.S. version, and that is the Biden and Trump rematch.
The point is that it's a close election. It can go any way. But you can just look at history to get some sense of how the market has behaved. The biggest thing right now is focus on what policies they're touting and try and see what the impact on the market is.
Good luck with that. Here is the latest. President Biden is preparing for Thursday's debate at Camp David with aides and advisors helping him hone his performance. The president will face off against presumptive Republican nominee Donald Trump, who is still on the campaign trail after holding a fundraiser in New Orleans last night. Mike Wilson of Morgan Stanley still with us. We aren't going to ask you about your impression about the debate. Actually, we may do that. But instead of doing that, to begin with, how do you even understand what to listen for in terms of the most market impactful policies from something like the debate that we're expecting on Thursday?
Yeah, I mean, look, this is going to be a challenge for the moderators to draw some answers out. By the way, this is not just because of this debate. This is the way the debates have gone for the last decade. I mean, it's just turns into not really a debate about issues. It turns into personal attacks and whatnot. So let's see if we can focus on a couple things. What I would love to hear about is what is your plan for fiscal sustainability? Okay, is it going to be any different? Is it business as usual? Right now, it looks like both parties are on this freight train of we're not really concerned about, cutting expenses or even raising taxes. I think the Democrats have talked a little bit about raising taxes, but that's going to be the main one for me. Like, what are we doing about this fiscal sustainability issue? Number 2 is going to be tariffs, how they differ on that, and of course, immigration. And some people might say, well, those are social issues. Well, they're not really. I mean, immigration is really an economic issue. I mean, it's a massive positive labor shock. So I think that's going to be a really hot topic from an economic standpoint. And of course, tariffs. I don't see as big a difference between the two candidates as some people do because of the actions more recently by the Biden administration. But I think there'll be some nuances. But those are the three big ones for me, economically speaking.
But there is a difference in the sense that Trump is calling for a 10% tariff wall around the United States plus 60% on Chinese imports. When you say you don't think there's a big difference, do you mean that you think this is just rhetoric and he might temper those numbers if he were to become president?
Well, I think he already has. I mean, that's his strategy, right? He's a negotiator where he'll set his BATNA over here and then, kind of move to the middle. That doesn't mean he's going to be softer on tariffs than the current administration. But, he tends to be extreme and then kind of move it over this way. But look, there's no doubt that I think that the Trump administration would probably be more hawkish on tariffs overall than the Biden administration. All I'm saying is that I think this is turned into more of a bipartisan support issue for tariffing in general, particularly against China. So I just don't think it's as big of a deal as it was.
Axios this morning has 16 Nobel economists writing that Trump would be basically very inflationary. We believe that a second Trump term would have a negative impact on the U.S. economic standing in the world and a destabilizing effect on the U.S.'s domestic economy. Do you think Trump is more inflationary for the U.S. economy?
Well, Trump wasn't. I mean, that was our call in 2016, was that, Trump wins, it was going to be really positive for the economy because he is inflationary. At the time, though, we had capacity for that. So I think that in the bond market, participants who we speak with are kind of thinking about this already. In the event that it becomes clear, and we don't know yet, but in the event it became more clear that Trump was going to win, then the bond market may start to price in a bigger term premium, which is one of our potential concerns. I don't think it's a risk right now because it's truly a 50-50, and you do need some congressional support. So it's not clear to me that there's going to be big coattails on this election, meaning whoever wins the presidential carries Congress. But if that were the case, then the risks of that go up. You would get maybe even more aggressive tax cuts in some way, and maybe tariffs can offset some of that. But generally speaking, yes, it potentially could be more inflationary. So better growth, but potentially higher rates.
Okay, so there's potentially an impact on the bond market, but will equity markets care?
Well, they will if it's term premium. And that's been our call now for the past year, which is if rates are going up because of growth and inflation being higher, stock market really doesn't care, at least at the index level. Now, if rates are going up because term premium is widening, that's a bad thing for multiples, generally speaking. We saw that in the third quarter of last year. So, an issue in a situation where the bond market starts to worry about fiscal sustainability in a more acute manner and term premiums started to widen, that would not be great for multiples.
Is this the reason why you don't believe the Fed put saving everything? I mean, this has been one of the arguments of the stock bulls, is that the Fed could cut by 100 basis points, and that could offset any of the weakness and create a real momentum to the market. Is the idea of term premium and the fiscal overhang the reason why you don't know whether the Fed put could actually have the same effect?
Well, what I would say is that the term premium, I think, has been under control more recently for reasons that have nothing to do with rates. It has everything to do with the liquidity provisions they put into place, smartly, by the way. So the reverse repo has been a big helping hand to help fund the government. Now the Fed, of course, is tapering QT, which is essentially $500 billion of potential bond buying across the curve on an annualized basis. So I think they have provisions in place to get us from here through the end of the year. I think if that stays the course, once again, 2025 is probably the bigger risk for the term premium to widen, no matter who wins. Because that's the whole point, Lisa, is that this fiscal sustainability issue is a bipartisan issue, and we've bought ourselves time. I think the government, the administrators have done a good job of finding ways to fund the government for now, but that risk increases as we go through the end of the year.
Steve Eisman's going to be joining us shortly, and he came on earlier and said there are all these the deficit people who've been worrying about it for a long time. You've replied to it saying, actually, it does matter this time around. But does it matter if the U.S. is just as bad, if not better, than, say, what's going on in Europe, what's going on around the world? Essentially, does it matter that the U.S. is not disciplined if the rest of the world has even less?
Yeah. In other words, you got to be not the slowest hiker for the bear to catch you.
Correct.
No, I think that's and look, we still have the reserve currency, and I'm not one of these guys who says we're losing the reserve currency and all that. I mean, we are in a very privileged position. Okay, I think we've abused that a little bit, and I'm not in the camp that we're going down the tubes. We can't fund the government, but we can get spikes. We can get temporary spikes like last fall, where the multiple went from 21 times to 17 times on the equity market. That's all we're trying to do. We're not here to call the end of the world. I mean, that's silly. Okay, we're just saying that this is a risk that's not currently priced. Term premium is 0 today, and I think that's probably inappropriate given the path that we're on right now, given both candidates, right? No matter who wins.
Mike Wilson of Morgan Stanley, thank you so much for spending time with us this morning. Coming up, we're going to be speaking about the industrial sector. Bloomberg's Benedikt Kammel as Airbus slumps on lowered guidance and missing parts. Somehow I just have trouble saying that, considering the fact that I don't want to think about planes struggling with parts, but this kind of goes to the industrial technology and supply chain disruptions that are ongoing. Right now, in markets, you are seeing just a marginal lift ahead of the open as people look at NVIDIA trying to claw back some of those losses. This is Bloomberg. Heading into Tuesday with gains, at least marginal gains, with NVIDIA trying to claw back some of the losses after 3 days of about 13% declines on those shares. NASDAQ 100 futures gaining the most, not surprisingly, given the NVIDIA rebound, up 0.4%. S&P futures up 0.2%. In the Russell 2000, really struggling to find footing here. What I find interesting is this idea that Mike Wilson was going over, Danny, which is basically lifeboats. And a question of which are the lifeboats, saying that you sometimes get a lifeboat that sinks and you move on to the other, but how much do these lifeboats keep the market afloat regardless of some of the cylinders that are raising some issues underneath?
I had great boating metaphors, because the other one I really liked was this idea that we're just running from side to side. One area takes on water, you go to the other side, and what you get is this calm that appears to be on the surface, this VIX that's incredibly low, but underneath there's this tension. And the question is when does the tension come to a fore in a bigger sell-off for NVIDIA that does take the entire market and the sentiment down with it?
And that is not happening just yet. Amy Silverman also with the paddling duck metaphor of the under the surface, the duck's feet going like this. Meanwhile, we're looking at the bond space. Not a lot of action, which is actually interesting in and of itself after a lot of volatility and huge swings by 10 to 20 basis points a day. Today, not that, less than a basis point move throughout the 2s, 10s, and 30s ahead of $69 billion of 2-year notes being auctioned off, 422 on the 10-year, 473 on the 2-year, and 30-year yields at 436. Meanwhile, when you look at the currency market, and this is interesting to me, not seeing the same kind of fear being baked into the market that you saw last week, even though the French election is getting closer, 107.14, a little bit of euro weakness. But Anne-Marie, we've been talking about this throughout the morning, that basically you've had more people actually say, maybe this is overstated in terms of the risk around some of these elections.
They think it's overblown, but and also to Danny's point, earlier, when you have members of the RN coming out and Marine Le Pen's party basically saying, look, we are going to be prudent. We are not the Eurosceptics that potentially you thought we were for decades. This is almost Marine Le Pen, who for decades has been trying to have influence, kind of taking the Maloney route, being like, I cannot freak everyone out because I want to be able to govern. And also, to everyone's point, it's going to be cohabitation. So we don't know exactly yet what that looks like or what that means.
The fact that you're both talking about this, the idea that the markets will ultimately provide a check on fully populist governments. And that's sort of been one theory out there, whether it's Donald Trump, whether it's Marine Le Pen, this idea that they can't go too rogue because they will want to cater to markets, which is a key question. Meanwhile, the question is, how much will the economy give them? Under surveillance this morning, San Francisco Fed President Mary Daly showing more concern for U.S. jobs. Daly saying, in quote, so far the labor market has adjusted slowly, but we are getting near to a point where that benign outcome could be less likely. Danny, I thought this was fascinating given such a shift in tone.
Huge shift. Usually she's more of a centrist. This feels much more to the dovish side, because the argument for a while had been that the reason inflation has been so stubborn is because we have this strong labor market. So what happens when it's not strong anymore? I think this is something that someone like Neil Dutta from Ren Macro would love to hear, because he's been making this argument that the labor market is starting to turn. It is at this inflection point, that inflation is starting to come down, and the Fed is looking in the rearview mirror. They're looking at past data instead of what's looking forward. So the argument goes that they're more likely to make a policy mistake. Mary Daly is kind of starting to reflect some of that language, that if we keep pushing hard, the labor market could move non-linearly.
So she's basically saying inflation's not the only risk. We've been talking about the past few weeks how jobless claims continue to tick up higher and higher. Potentially, is that a trend? Maybe it's getting her attention. But I also loved how she told this room of founders and the San Francisco elite, Get your workers back to the office. It will help the local economy.
Well, that's been a tone that we've heard quite significantly, usually from the big bank CEOs, but also, I guess, from the San Francisco Fed president as well. The Biden administration, talking about home prices and commercial real estate, the Biden administration is looking to take on the rising cost of housing, kind of the flip side of things. Treasury Secretary Janet Yellen is promoting new efforts to increase the supply of homes, including a measure which would provide $100 million over the next 3 years to help finance affordable housing. A lot to unpack here, AMH. It's interesting to me that this is coming at a time where it is a political hot button issue. How much is this politics and how much is this real?
This feels like a springboard into the political narrative in the upcoming months ahead. When you look at some of the polling and the data that's been done, Morning Consult recently done some of this, 74% of respondents that they surveyed believe that the lack of affordable housing is a significant problem in the U.S. You see that sentiment. And then if you look at Gallup, their survey over the course of years, we're looking at this past April, when you ask people, is it a good time or a bad time to buy a home? 21% only say it's a good time. 76% say it's a bad time. Why? Because mortgage rates are so high and the supply is not there. We've been talking about this, and clearly the Biden administration is trying to tap into that.
Which potentially goes a long way to explain why consumer sentiment surveys have been so bad on the economy, despite the rest of the economy being pretty okay. But to that point, Anne-Marie, I mean, is adding supply on really going to change the game? The reason that the affordability index, the Atlanta Fed, has one its worst since 2007 is because of mortgages. Unless you get some cuts in size matched with supply, it's not necessarily clear that housing affordability will get better. And just to make us all more mad, we also learned in the post-financial crisis that, low rates on their own also don't solve the affordability issue.
But this actually, and something that you said, AMH, really stands out to me, which is essentially the reason why you see sentiment shifting to such a degree, especially among younger voters, is because they can't get access to home price, to owning their own home. They're facing increasing prices across the board. If they don't have assets in the stock market, they can't offset some of the inflation the way that people who are older and more established can. This is a fundamental problem, and it's unclear how anyone could really shift in this face of this.
That's right. They can't get on the housing ladder, as you say, and also they are still being dogged down by inflation. And this is the biggest issue going into November. It continuously comes up in polls, and it's going to be a huge issue on the debate on Thursday. You're not allowed to bring props, but over the weekend, Trump actually pulled out a little miniature Tic Tac container. And he said, this is Bidenomics. And when I come into the office, we're going to have Maganomics. And he's going after what people feel about these rise of prices. It's very hard to talk about rate of inflation coming down when people are just thinking in terms of price levels.
And if they're concerned about the price levels of things that they do all the time, the question is, what are the price levels of flying around, given the fact that some of the deliveries of airplanes are going to be slowed, not just from Boeing, but also potentially from Airbus. Airbus is slumping after a new warning on missing parts and fewer deliveries. The jet maker saying it's experiencing a shortage of millions of parts and will have it to cut back expectations on new planes, including the A320. Bloomberg's Benedikt Kammel joins us now from Berlin. Benedikt, before we get into this specific issue, why is it there are still supply chain delays and disruptions now, whether it's hungover from the pandemic or not, given the fact that people have been saying, we've right-sized, this is the normal economy, we are beyond the pandemic disruptions?
You raise a very good point, and that really is the question that hangs over Airbus and Boeing. Their answer would be the complexity of our product is such that you can't compare it to anything else out there. It's not a car. It's not another industrial product. We're lacking the engine parts. We're lacking the aeronautic components. We're lacking the interior elements to our planes, so sort of seats and tables and things like that. We're also lacking the skilled labor that we need to do this. And it's not just Airbus and Boeing proper. It's the suppliers. So the smaller tier 2, 3 type companies that are really struggling to get their products to Airbus and Boeing. So this is really a supply story. It's not a demand story. I mean, this is sort of, they find themselves in the weird situation that they are actually selling their planes very well, almost too well. The demand is really hot, and they just can't keep up with it.
Benedikt, you raise an excellent point, which is that basically they're having issues with the parts, with the expertise, with the talent to be able to manufacture that. And that's really what's causing some of these kinks. This is not about the pandemic. Going forward, given all of the localization that people are looking for, what does this say in terms of the workforce and the lack of training at a time where everyone's on their phones for everything? It's not like there's some sort of natural training in order to do technical expertise going forward in the vast majority of younger populations.
Yeah, this is really a long-term effort to sort of resize the industry and to get people interested in this industry. Again, what kind of training do you have to introduce? What kind of incentives? And ultimately, what does a relatively cash-rich company like Airbus, what can they do to stabilize the supply chain? The ultimate sort of fix would be to go into some of these small suppliers and actually prop them up. We're not at that point yet, but you're seeing it in cases like Spirit, for instance, which is in the process of being bought by Airbus and Boeing, that this is a case where one supplier that is in trouble is being bought back up. And you might see more of that going forward, that Airbus and Boeing will get into some of these mission-critical suppliers, because all you really need is sort of one missing part and you can't build your plane. These are very complicated products. They have millions of parts. And as I said, one piece missing, two pieces missing, and your plane is stuck on the factory floor.
So we have Airbus on top of Boeing cutting back on their targets. What are the domino effects now for the airlines that want to buy these planes?
Yeah, this is obviously going to play out with the airlines, and ultimately, people like you and I who get onto these planes and have to pay higher prices because you're going to have fewer planes out there, you're going to have less capacity, fewer seats available. That's going to drive up the cost. And one big theme from the recent IATA annual general meeting in Dubai was, where are our planes? We can't get them fast enough. We have all these orders outstanding. We want the new kit. We want the more fuel-efficient planes. Fuel is a huge cost element for the airlines, and they just can't produce them fast enough. You heard from Airbus yesterday. They're cutting back on the rate of production. They're going to make 75 A320 planes a month, not in 26 as they had planned, but in 27. So that means 1 year later, they're going to reach that rate, and that will have that ripple effect to the airlines, but ultimately, the humble customer.
It was also at IATA in Berlin, Benny, that Fari of Airbus basically said this is going to be something that takes 3 to 4 years for the supply chain to sort itself out. Take us to 3 to 4 years from now, Benny. Does something need to fundamentally change if we're still having these problems? Or is it a case we can just play catch up and maybe in the next decade it will be how it once was?
Well, this is an extremely long-term type industry. I mean, if you think about the products we all use, these are planes that have been around for a very long time. So this is an industry that thinks in not quarters, it thinks in years, and sometimes even in decades. So they are very mindful of this, and Airbus is doing its part. They are looking deep into the supply chain and seeing which are the suppliers most at risk, where can we prop them up, which ones can we fix. Look across the other side to Boeing, and they obviously have a whole raft of issues, and they are probably in a less sort of stable situation to be able to address that. So that's something that we'll have to watch very clearly. And that might also explain why Airbus, is not taking any pleasure in Boeing's misfortunes, because they know we need both companies here. We need Airbus and Boeing. We need a healthy industry out there in order to help the supply chain as much as ourselves. So Airbus also has an interest in Boeing, catching its breath again and getting back on its feet. So, in a couple of years, once you have a new Boeing CEO, once that company is stabilized again, they will sort out the supply chain. But if anyone thought this is something that is a quick fix and once the pandemic's behind us, that's not the case.
Benedikt Kammel of Bloomberg, thank you so much for being with us. Right now, let's shift gears a little bit, get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackis. Yahaira.
Hi, Lisa. Fed Governor Michelle Bowman says she sees a number of upside risks to the inflation outlook and reiterated the need to keep rates higher for longer. In prepared remarks in London, Bowman said a tight labor market, geopolitical developments, fiscal stimulus, and a loosening in financial conditions present risks to the inflation outlook. Bowman also pointed to a more open immigration policy in the U.S. as a reason for differences between the U.S. and other major economies in recent months. Apple has no plans to integrate Meta's AI chatbot into its iPhones, according to people familiar. The Wall Street Journal had reported the iPhone maker was in talks with the social media company, but Bloomberg News has learned those talks didn't get very far. Sources tell us Meta approached Apple months ago, but was turned down because the iPhone maker doesn't believe Meta's privacy practices are strict enough. And Italy is headed to the knockout stage of the Euro 2024 tournament after a dramatic match against Croatia. A goal in the final minute of stoppage time was enough to secure a 1-1 draw and avoid an early exit from the tournament. Meanwhile, France is set to welcome back captain Kylian Mbappe for today's match against Poland. The striker is set to play with a face mask after breaking his nose in the first opening match against Austria. That's your Bloomberg Brief. Lisa?
Thank you so much, Saira. Up next, gaming out a patient Fed.
The Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table.
That's coming up next. This is Bloomberg Surveillance. Coming into Tuesday with some gains, NVIDIA trying to claw back some of the losses after 3 days of declines. You can see an upward tilt, but just modestly so. S&P futures up 0.1%. NASDAQ 100 also just up about 0.4%. Euro losing a little bit of steam after gaining yesterday, strengthening versus the dollar today, weakening 107.12. Yields heading a bit lower, 4.21% on the 10-year. And this comes after a series of comments. Mary Daly coming out and seeing more downside potential risk to growth. But what we're hearing from Michelle Bowman this morning is that there could be upside risks to inflation and saying it is not the time to cut, which raises the question under surveillance this morning, gaming out a patient Fed.
If you continue to get market progress on inflation, even if the economy holds up well, the Fed probably by September is likely to conclude they've made enough progress to start easing rates. So even if the economy is resilient, I still think September is very much on the table. But that case that we talked about earlier of a continued easing after September, there I think you really need that sharper downturn. Otherwise, the Fed's going to start easing, but be very patient.
Here's the latest. Treasury is holding steady as traders look ahead to consumer confidence, as well as remarks from Fed Governor Lisa Cook. Greg Peters of PGIM writing this. This remains a reasonably decent backdrop for risk, taken from an overall top-line perspective, yet the valuations are seemingly priced for much of this positivity and perhaps then some. Greg joins us now. This is fascinating to me, Greg, because you're talking about how you get the risk on, but the upside risk from here seems somewhat limited. So what do you do?
Yeah, so I think you have to tread quite carefully, honestly. So, if you strip away valuations, which is impossible to do, of course, we'd be much more bullish. But if you look at spread sectors, for example, you're at very much at the tight end of the historical range, both on the high yield side and investment side. I think investors continue to overpay for levered credit risk. So we see more value in the unlevered or the top of the capital structure. So I think what it means in short, Lisa, is that you have to pull back, make sure you're getting paid for the risk that is on the horizon and always lurks.
So in other words, if I'm hearing you correctly, Greg, right now the concern is that there could be some kind of growth scare akin to what Mike Wilson was talking about with respect to the idea that the credit component could widen out, but not necessarily on the high end of things where it's more duration sensitive. Is that what you're saying? That essentially yields are going to go down. It just matters how quickly and in the face of how much weakness.
Yeah, I think that's right, Lisa. And it's not so much about preparing for a growth scare. Like, that's not a base case over the short term, but you just never know. And these unforeseen circumstances do arise, and you as an investor have to make sure that you're appropriately paid. And we are priced very much for perfection here.
You have seen some of that turn in the high yield market, Greg, where the worst among them has started to finally underperform. That spreads are finally starting to spread out. But in this more leveraged part of the market, the one that you're worried about, why are you worried? How bad does it get in an environment where we maybe get just 1 or 2 Fed cuts this year?
Yeah, so I mean that's that point is an excellent one. So what we're excited about in the lever part of the credit markets, like high yield, for example, is that you're seeing this dispersion, and so the markets are differentiating. So that's great news for active managers like us. But in kind of a beta standpoint, it's less exciting. But you don't necessarily need to have a recession or a real downturn to see these lever credits start to bite. And the reason is just the persistence of higher rates starts to eat into these already levered capital structures, and it takes time. And that's why you're seeing higher default and distressed activities for quite some time.
So I guess is 50 basis points of cuts enough to solve that? Or is it cuts in real size to prevent some of the distress?
I don't think it's enough, but it's important to dissect why they're cutting. So if there's a cut because growth is rolling over, that typically means that the top line is also rolling over. And so is that really enough? And my guess is no. If they're cutting because growth is really quite strong, but it's just disinflation in the system allows for some scope, then that's a better narrative. So I think the markets continue to conflate those two narratives. Is it labor market weakening? Is it disinflation? I think both is somewhat heroic.
In the meantime, if you wait for about 2 seconds, you'll get a new narrative. So just hold on 1 minute, and then we'll have a different thing dominating market activity, which really raises the issue that we've been talking about a lot. Lori Cavasino, we keep quoting her, staring into the sun in terms of this election season, given the fact that there's a whole deal of uncertainty. You talk about how most people are just sitting on the sidelines, at least when it comes to bold bets ahead of what we're going to expect in November, but frankly, around the world. So how do you know when you can kind of have conviction given some of the policy uncertainty, or do we kind of already know the outcomes regardless of who gets into office?
I don't think we do know the exact outcomes. If you think about, what's happening in France currently, we saw it in Mexico. It's very much a shot across the bow for, a very big election. But here in the U.S., it's been a very good year thus far. So I just don't see the appetite to take a lot of risk going into the U.S. election. But once we get to the other side, I think the policy differences are quite different and matter a lot. And, I see as a bond investor, I see more concerns around higher bond yields due to inflationary type of policies. And those are the areas that I'm most focused on.
But Greg, isn't that going to be the case for either candidate if they become president?
Not exactly. So I think we're all of the mind that fiscal is very much an issue that's embraced on both sides of the aisle, but the contours of that fiscal are very different. So tax cuts have a very different multiplier effect, let's say, than spending on infrastructure. You look at some of the trade policies, highly inflationary. I just think the details matter here. So just to say, fiscal is going to rage regardless of who's in office and who has control, I think misses the contours of how that fiscal is achieved.
We also need to know the makeup of Congress to really understand what these policies could look like. Do you have a base case of what potentially you're planning for after November 5th?
No, I mean, at the end of the day, I'm a bond investor, right? Not a political analyst. We do provide scenarios because we have to think about it. But I will say, if you just pull it back, zoom out for a moment, everywhere I look, I see more inflationary pressures, not less. You think about it from, a defense spending standpoint. You think about it from just the trade war standpoint. You think about it from, spending on energy, both current needs and then for the future, all inflationary. So the one thing that seems common wherever I look is that there's more pressure for inflation than disinflation.
Just quickly here, do you like French bonds?
Too early, but it definitely looks like there's a path for success here. That's a great example, Lisa, because kind of in the meat of the distribution looks quite attractive. But the extremes are the things that the markets are worried about. And the setup of the French election just makes it difficult with investors trying to kind of game theory that out.
Greg Peters of PGIM Fixed Income, thank you so much for being with us. We really appreciate it. And for giving Anne-Marie a reason to bring up cohabitation once again. You really love that phrase, don't you?
Well, he's saying that doesn't look like it's going to be as bad. And that's because people are looking at cohabitation amongst all these parties. That means no one party is going to get their way. So those Euro people who are worried about maybe the Euro skeptics coming in, you know, they could pump the brakes a bit.
Well, and I like the idea that you bring up, which is the ghost of the Liz Truss moment, and how much that's kind of hanging over a lot of this.
Yeah, exactly. They know that the market can bully them out of the office. They don't want to be the next Liz Truss. But by the way, might I just add that the reason cohabitation is so wonderful is because it also just implies that they're like there but not getting along. They're like there, they're like we're cohabitating because we have to. I don't know, it's just evocative. It's a good one.
Yeah, well, it also implies other things as well. Meanwhile, coming up, Steve Eisman of Neuberger Berman, Saira Malik of Nuveen, as well as Mark Zandi of Moody's, as we plow forward to consumer confidence, to a 2-year auction, to Fed speak, and then on to Friday, Thursday and Friday, when we get core PCE as well as income and spending at a time when we do see these lifeboats holding markets afloat at that 55 and above level on the S&P. Dollar strength, yields strong. This is basically where we're at. Stability. This is Bloomberg.
It does feel like for the first time in a while, the market has really been attuned to downside risks and growth.
The economy is clearly showing signs of deceleration.
I don't like the situation with the Fed, and I don't like the fact that the economic story seems like it's slowing a little bit right now.
In the next couple weeks, we could start to see just a continuation of the softer economic momentum.
A sharper downturn by no means is guaranteed, but I think the risks of that are higher than they were, let's say, a few months ago.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Horder.
Heading into a day where there's a real question here about NVIDIA and whether it makes the market more stable or more fragile. Good morning. Welcome back. This is Bloomberg Surveillance. Anne-Marie Horder, Danny Berger. I'm Lisa Abramowitz. Jonathan Ferro will return. He'll return on Thursday. Right now, still a lot of discussion around the importance of NVIDIA and whether this is a stock that makes the market more secure in terms of just the AI dominance or more fragile, Danny, given some of the huge fluctuations in market cap that we've seen recently.
I'm just still really struck by the fact that NVIDIA can fall so much in 3 days and the overall S&P falls less than 1%. I mean, it's kind of like the most constructive sell-off we probably could have had for NVIDIA. And again, it points to this idea that we're not necessarily in a narrative shift, maybe just a breather, maybe just a quarter-end rebalance.
Which is something that Mike Wilson was talking about, that it would take some sort of shock to shift the narrative to something where even the lifeboats, the NVIDIAs, but also other stocks that have similar kinds of attributes to be pegged to some of the growth, that it would take something significant to really bring them down, and that could be some sort of growth shock. And Anne-Marie, this is something that we're hearing about from the likes of Mary Daly of the San Francisco Fed. It's not an economy that usually turns slowly. And if you start to see that softening in the labor market, it could be the beginning of something that's a little bit deeper.
Right. And this is actually a little bit different than we normally hear from Mary Daly. And basically what she's saying is that it's not just all about inflation right now. We have to keep an eye on what's going on in the labor market. We've talked about it a lot. We do see jobless claims rising. Potentially, when you see maybe more cracks in the labor market and consumer sentiment, does it start to shift people's minds as well about a Fed cut before the election? Maybe September is becoming a little bit more in play.
Which is the reason why people are looking at consumer confidence, which we get at 10 a.m. today. The reason why people look at the University of Michigan sentiment survey, even if only 500 people answer the phone, and even if it's now being conducted online. But Anne-Marie, Danny, there's this question now going forward of just how much we can really see the narrative shift that much more, or whether in some ways the Fed has kind of put a put over the market where essentially growth risks they're going to respond to and otherwise not so much.
Especially when you have Michelle Bowman coming out. I mean, look, she's always hawkish, but coming out saying they have more work to do. So the question is when we get to that point where maybe the cracks in the labor market are more apparent, when some of the doves on the FOMC want to cut, will there be a big pushback? Is there enough of a disagreement at this point that even though we hear Mary Daly starting to shift her sentiment, that's not enough to really get us going?
Right now in markets, you're seeing a lot of stability, at least some sort of firming up in equities. You could see the S&P up about 0.2%, euro weakness 107.12, kind of stabilizing holding in this area after going south of 107 last week. And then you can see the 10-year yield, 421, marginally lower. Crude also inflecting lower about 0.8%, $80.96 on the NYMEX. Coming up, Steve Eisman of Neuberger Berman, who coined "Oi the deficit," but he's going to be talking about the AI trade. Nuveen, Saira, Malik on election year, market volatility, and Mark Zandi of Moody's Analytics on why a Fed policy error is the biggest threat for the U.S. economy. We begin with the big issue. A tech rout pushes markets to take a breather for a hot second. NVIDIA shedding close to $430 billion in value, the biggest three-day loss for any company in history. Even with that slump, and this is the key, the chip giant is up close to 140% this year. Investors still flocking to the company, given the sky-high demand for its chips, which are powering a broader AI push. Steve Eisman of Neuberger Berman remains bullish on the AI play, saying the AI frenzy and a correlating boost in infrastructure is powering the U.S. economy. Eisman also expecting Apple to benefit from AI with a major upgrade cycle. And he also has a couple of reviews for the latest Marvel movies. Steve, I'm so pleased to say, he joins us now. Steve, who coined "Oi the deficit." I literally quote you every single day on that. We're not going to talk about that just yet. I don't know if that's good or bad. I'm not sure either. A lot of people push back, but I think it perfectly encapsulates what a lot of people have been thinking. And it goes to this broader angst in markets you kind of push back on. I'm going to start with the question we've been asking all morning. Is the huge swing in NVIDIA shares a sign of market fragility or actually market strength, as Danny pointed out, given the fact that we're not seeing some broader retrenchment?
I mean, if you look at the chart on NVIDIA, you can barely see the correction. So, I mean, on a percentage basis, it's down something like 10%, but you have to peer really, really carefully at the chart to see that move. So, I don't think it means anything.
There is this issue, though. How do you even understand the valuations at a certain point? How do you even understand how much future profits are you actually factoring in? I understand the idea of being bullish on AI, but how do you understand when it's so fully valued that you're jumping on a train that's so overpriced?
I absolutely never do. I just don't know. And I'll take the converse to it, which is, one of the things I learned running a hedge fund is that shorting a stock solely because of valuation is a death wish. I made that up too, by the way.
That's great. Trademark.
But what I mean by that is, you go short a stock because you think the valuation is insane, but your entire thesis is just it's very expensive. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like NVIDIA is obviously intact, the story is going to continue. So you have to have, when you short something, not just that it's expensive, it's that the story is going to break. And as far as I can tell, the NVIDIA story is going to last for years. So, I don't think all that much about the valuation of NVIDIA.
So maybe you don't want to short it because it's a narrative and it's an enduring and a powerful
narrative.
I own it. So you own it. Okay, question for you then. You look at 10% dip, 12, whatever it was on the chart. Do you buy more?
Well, we own a lot, so there's portfolio construction issues about how much you can have in a portfolio. One of the interesting things about this market, which presents a problem to portfolio managers today, which I don't think has existed before, is that some of these stocks, NVIDIA, Apple, Microsoft, represent very large percentages of the S&P, and so. Normally, if you would take a position in the stock, you would say like a 5% position would be a big position in the stock, but those stocks have bigger positions in the S&P. So you're sort of the normal risk parameters that apply to constructing portfolio don't necessarily apply to these stocks.
I think that's such an interesting point. Also because if you're an active manager and you want to outperform, you kind of have to be so overweight these stocks.
Or at least equal weight.
Which again is kind of beyond the normal risk parameters to have so much concentration in these stocks. So even though the story is there and it is powerful, does that do something to your volatility profile, which you maybe don't like, when you can have swings like this in NVIDIA over a 3-day basis?
I don't really focus that much on the volatility. I have a colleague at Neuberger who likes to say that one of the benefits of buying and holding is that you only have to make one decision. Whereas if you're a trader, you have to make multiple decisions, and it increases the probability of you making a mistake. So if you like the NVIDIA story, you own it. and you keep owning it until something changes. And I don't think it's going to change for a long time, so we'll own it.
If you like NVIDIA, do you also like Micron and AMD? I mean, do all of the sort of semiconductor stocks benefit equally?
But you can't own everything, you know, unless you just own the index.
Yeah.
So yeah, we like AMD. We don't own every chip stock. You know, one of the things that I think is very interesting is, you know, when you're talking about, leave out Microsoft, software versus hardware. So for years, software outperformed hardware. And one of the reasons that software outperformed hardware is that the whole software industry moved to the SaaS model, which, you know, everybody went crazy about, et cetera, et cetera. There's an argument to be made that hardware, which has recently outperformed software, is going to continue to outperform software. And this is an outgrowth of AI. And this is not my theory. I'm not smart enough to create this one. But it's a very interesting theory. I think we should talk about it for a little bit. It's a very long-term story. And the thesis is that because of AI, the cost of creating software is going to collapse. And so therefore, some companies, unclear who, in the software industry, which people value very highly because they have these very large moats, those moats are not going to be so high anymore. Now, if this thesis becomes true, then hardware will continue to outperform software, and software will get derated. That's a very long-term story, but I think it's very interesting.
But this hardware is coming from Taiwan. Do you have any sort of concern about the geopolitical?
I'm petrified.
No, seriously.
No, I think, look, God forbid we wake up one morning and China has invaded Taiwan. Our economy gets hurt very, very, very badly, because where are we going to get our chips? I mean, that's one reason why Taiwan Semiconductor is building plants in the United States, but they haven't been built yet.
Yeah, but we're years
from that.
Years.
No, I agree. Is that
your biggest risk for holding all this
geopolitical risk is the biggest risk, I think, to the market, and I have no way to predict it.
Well, so to me, this sort of raises a question. Is it going to be geopolitics or a growth scare? We were talking to Mike Wilson earlier, and he was saying a growth scare could torpedo some of these lifeboats in particular, some of the semiconductor providers, just simply because there won't be as much investment. Are you saying that's even less of a risk?
I don't see a growth scare at this point. I really don't. I mean, you know, you guys were talking before about the Fed. You know, my view on the Fed is it's not relevant. And the reason why I say that is, I mean, the Fed was relevant when it was raising rates 500 basis points. That's relevant. That's repricing of money. I mean, the people who are the most dovish, I mean, what are they talking about? One rate cut this year, maybe one or two rate cuts next year. You know, in the scheme of things, that's de minimis. It's not really. I mean, it'll be important on Fed Day. You know, like I think I said here before. You know, on Fed Day, they treat Powell like, you know, Moses coming down with the tablets. Let's check that to make sure the 10 Commandments have the same words in them that they had last time, because that'll change morality forever.
Good.
But other than that, it's not that relevant.
Okay, so just putting this all together before we shift to politics in just a bit, I am curious about the idea of crowding risk. If there is potentially a catalyst, some innovation, or even just increasing tensions in around Taiwan, how difficult could that be given how crowded some of these names are? In order to exit, what could potentially happen? I mean, is that something to even prepare for, or is it just something that's so cataclysmic it's not even worth it?
The way I think about that is, look, like I said, God forbid China invades Taiwan. We'll have a lot more problems than what's in my portfolio. You know, so we'll all lose money. You know what? That'll be the least of our issues.
Okay, well said, Steve. Okay, with all of this, I can't help but wonder why I should do anything other than just hold the S&P 500. Why I should do anything other than just hold a passive portfolio, because that gives me exposure to all the big
caps. That is fine for a lot of people.
Sure.
I have no arguments about that. I do think that we are in an era of stories, more so than we've been in a very long time. And you can construct a portfolio which emphasizes some of those stories more than just the S&P does, and you could outperform. That's how I look at it. But I don't have any argument. If somebody wants to invest in the index, God bless.
Basically, if this were a movie, it would have a lot of stories, and the plot would be AI, and it would be a good one, according to Steve Eisman, who will be sticking with us and maybe giving us some movie reviews. Right now, let's get you an update and stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. The Biden administration is looking to take on the rising cost of housing. Treasury Secretary Janet Yellen is promoting new efforts to increase the supply of homes. This includes a measure which would provide $100 million over the next 3 years to help finance affordable housing. The rising cost of homes and rent has put added pressure on Americans. The average 30-year mortgage in the U.S. is 7.25%, according to Bankrate.com, the highest in decades. The nearly 15-year battle over the prosecution of Julian Assange may finally be coming to an end. The WikiLeaks co-founder is expected to plead guilty on Wednesday to leaking U.S. national security secrets. Assange was accused of publishing sensitive U.S. military documents in 2010 and 2011 in one of the largest breaches of state secrets in U.S. history. The plea deal would allow Assange to avoid prison in the U.S. and return to his native Australia. And OpenAI has warned developers in China it will begin blocking access to its tools and software starting July, according to local media. Screenshots posted on social media appear to show the Microsoft-backed startup already sent memos about the impending move to developers. It's unclear what caused the move, but it comes amid growing pressure from Washington to curb Chinese access to advanced AI technology. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, the morning calls, and later, Nuveen's Saira, Malik, and Mark Zandi of Moody's Analytics on Fed policy and more. That's coming up next. This is Bloomberg. Time now for the morning calls, not just movie reviews. First up, Deutsche Bank downgrading Airbus to hold as the plane maker lowered its earnings and delivery targets. The analyst citing a, quote, rather damaging profit warning. Next up, Goldman Sachs initiating coverage of Paramount with a sell rating. The firm encouraged by progression towards streaming profitability, but doesn't see enough to offset linear cable headwinds. And finally, TD Cowen upgrading Gap to a buy. The analyst saying the retailer is in the, quote, early innings of a transformation across its brand portfolio with underappreciated growth potential, talking about years and years of lost growth after a lot of people said, why are you not coming up with more staples? What is this with this fast fashion? Neuberger, Berman, Steve Eisman still with us, not to talk about fast fashion, but I did want to get you on politics because you have some pretty bold stances on it. And I want to know whether you're actually betting on that sort of 200% confidence that you have that Donald Trump is going to be the next president. I mean, how do you translate conviction in politics into actual wagers in the market?
This is going to sound a little strange. I actually think it doesn't matter who's president for the market overall. I really don't. I just think some of these themes of AI and infrastructure are just so powerful that it doesn't matter. Now, on the margins, there'll be, certain sectors. So if Donald Trump gets elected, I'm sure natural gas stocks will do better. Some solar stocks will probably do worse. So there'll be subsectors where things will be better and things will be worse. But for the overall market, I don't think it matters. I just don't think it matters at all.
Well, what do you make of these 16 Nobel laureate economists coming out today saying that Trump's going to be an inflation bomb on the economy and he's worse in terms of inflation than Biden?
I think it's ridiculous. I just think it's ridiculous. I mean, based on what? Because there'll be more tariffs.
Tariffs, tax cuts.
Does that mean it'll be slightly inflationary? Maybe. But, one thing I've always learned about things as broad as like things like inflation is things that cause inflation or cause inflation to get better are so broad and there's so many factors that, the fact that Donald Trump's going to be president is maybe marginal.
Since last time you were here, when you shrugged off the people concerned about the deficit, calling them the deficit people. The nonpartisan Congressional Budget Office ramped up its estimates for the U.S. budget deficit by 27%. There is growing concern about the U.S. fiscal trajectory. Does any of this concern you at all since the last time we spoke to you?
So this is why it really doesn't concern me long term. At the end of the day, the U.S. dollar is the reserve currency of the world. And one of the major reasons why it is the reserve currency of the world is that we have the most liquid and best government bond market in the world. So if you're a major institution, basically anywhere on planet Earth, and you need to park money, you buy U.S. treasuries. That's what you do. There's no alternative. You're not going to buy Italian bonds. You're not going to buy Chinese bonds. You're not going to buy, Mallorca bonds. You have to buy something that is big, liquid, etc. And as long as that's the case, the US dollar is going to remain the reserve currency of the world. And until somebody can show me why there's an alternative to the US government bond market, will remain the reserve currency. And the deficit is just not going to be that important.
There is this issue, though, of policy consistency and this idea of exactly how the U.S. can be consistent in how it approaches markets, how it approaches the world, and working together with allies and some of these issues that do factor into the U.S. being the most liquid market in the world. And on the margins, some people say it's not going to happen all at once, but you could see that erosion. And people aren't worried about a wholesale blowout in yields, but just sort of more volatility on the heels of certain proposals and things of that nature. Are you basically saying it doesn't matter long term because we'll move past that and it'll just be these main themes? Or are you just saying that honestly
people
you don't
need
see
things
happening?
to talk about? They need something to kvetch about. Okay, so they'll kvetch. And we'll go, the deficit. That's how they kvetch, But at the end of the day, the dollar's a dollar in the U.S. government bond market. It's the U.S. government bond market. And as long as that remains the case, we can have deficits. Now, do I think at some point it'll be important? Maybe, but people are pontificating. Do you see rates going up? I don't see them going up. They're going down. So until then, next story, basically.
Okay, well, I'm going to do an adjacent story.
Fine.
I apologize in advance.
Don't apologize.
But one of the concerns about it is that, sure, central banks hold bonds, but the switch has happened. We're now it's foreigner individuals who are the biggest holder of bonds. They've supplanted foreign central banks that are the biggest holder of bonds.
Right.
You're also in this environment where, because of more regulation, banks are holding less on their balance sheets. So all of a sudden, there's more potential for upset in this bond market. Not necessarily that the deficit will necessarily cause it, but weaker hands are holding on to bonds now.
I don't think they're so weak. Is there any indication that they're weak? 10 years gone from 4.5 to 4.2. I don't lose sleep at night about this one. I just don't.
All right, so then I guess that the bigger picture is how
I sleep very well, by the way.
I could tell, and you watch a lot of movies,
I do.
And you have a great life, and you've been along some of the bonds that have won, some of the stocks, that have won the biggest. I am wondering, though, exactly how you diversify then. Do you just not diversify? Do you have enough conviction to say, these are the things that are going to win, or do you need some sort of ballast that could be the bond market, that could be cash?
I mean, first of all, it's nice to be able to buy 3-month U.S. Treasuries and get more than 5%. So if you need to park some cash, that's fine. Owning some corporate bonds is fine too. But generally, what we do is equities, and that's what we've always done.
So you do equities and you do movies.
And just U.S.
Yeah, and just U.S. You also do movies. Do you have any new recommendations, since you do have this list of 100 in the Steve Eisman catalog?
I don't have a new movie recommendation. There was a new show on Hulu called The Veil with Elizabeth Moss, which was pretty good.
She's excellent.
My favorite is that he's into Bridgerton. He's an equal opportunity reviewer, although not so into Marvel, right? You're pretty passionate.
Well, I'm very passionate about it. I'm just very upset about what's happened.
All right. Well, we'll get into that another time. Steve Eisman of Neuberger Berman, thank you so much for being with us. Always a pleasure.
Thank you.
Always insightful as he sort of touts the AI narrative. And I love that idea, Danny, of the idea of stories. And this is a market driven by stories more than at any time in recent memory. And you don't want to bet against a good story.
not only is it a story, but it's a story that like our tiny little human brains have a hard time comprehending of the actual power of AI, of how this thing gets used and how quickly it advances. I mean, I think that's why ChatGPT caught us all so by surprise, because it almost seemed like overnight this like amazing thing appeared that we could all use. So it's trading a story that we don't even understand the potential for. And I think that's why so many people are excited about this stock and are willing to buy it even at its current valuations.
Meanwhile, I do wonder how much, Emery, we're looking at a territory where people can sort of bet on the preeminence of technology over politics. We don't hear that many people saying that politics just don't matter. I mean, that's actually a new one, I think, for a lot of people who come around this table.
It's true. Within 15 minutes, went from Greg Peters, who's basically saying November is going to be a coin flip and you should just hunker down for the summer and wait it out, to Steve Eisman, who's basically saying none of it matters. It really doesn't matter who's going to be president of the United States. On the margins, he thinks maybe it matters for things like natural gas, even though under the Biden administration we have record fossil fuel production, which they don't always like to tout. But he really doesn't think that is a driving force right now in the market. So I guess it's what everyone says, holding NVIDIA.
Well, looking ahead to today, we're going to be watching lots of things that Steve Eisman is not, like the bond auction at 1 p.m., the two-year debt auction. We're also going to be looking at some Fed speak coming up, and we're going to be looking at consumer confidence coming out. I am curious to see how people are feeling at a time where the equity market is trying to reverse some of the losses over the past few sessions. NVIDIA gaining, as is the rest of the equity space. We're also 2,000 lagging behind, yield stable, commodities a little bit lower as people take a look at some of the supply. This is Bloomberg. About 60 minutes until the start of the trading day. We do see a bit of positive momentum, maybe because it's all stories. The stories are pretty good right now. S&P futures up 0.2% at 55.27. NASDAQ futures up 0.4% at 19,833. No one ever quotes the NASDAQ in terms of the level in the same kind of way as the S&P. I was just thinking about that. The Russell's 2,000 basically unchanged. Danny, to me, I'm just keep thinking about this. You know, I'm about to run through some numbers, and none of it matters to Steve Eisman. It doesn't matter what the Fed does. Doesn't matter what the economy goes. Doesn't matter about whether people are concerned about the fragility of NVIDIA, because it's stories and the story is working. So why fight against it?
All the thing that matters is stories. You know what number of people do quote is NVIDIA. It's like, forget about the Russell 2000. The new things we need to watch, S&P, NVIDIA at 120. It's all just numbers, in the words of Peter Tchir.
I mean, in fairness, the NVIDIA accounts for basically the entire market cap of the Russell 2000. So there you go. I think the five mega caps do anyway. Looking at what we're seeing in the bond space, there is calm, maybe before the storm, or maybe it doesn't matter. We're looking at the potential for a $69 billion two-year auction at 1 p.m. today, to potentially be the first in a slew of Treasury auctions to really get a gauge on where investors are right now. Right now, you can see stability in the bond space. Yields just marginally lower by about a basis point on the 10-year and on the 30-year. 422 rounded up on the 10-year, 435 on the 30-year. Two-year yields really stable in this 470 to 475 level, 472.31. And in the currency space, you do see a bit of euro weakness, just simply banking on what we saw last week, still above that 107 level, although really retracing back down, maybe even potentially crossing it, 107.09 right now, after those French elections really remaining in the forefront. And Emery, I mean, this to me is where politics do matter. We saw a pretty substantial response in the euro region to this French election, the first round of which starts on Sunday.
Starts on Sunday, and you see the rhetoric really starting to ramp up going into the first round. Emmanuel Macron talking about the fact that there could be a civil war between the fact that you have the far right and the far left gaining ground. But we have seen Marine Le Pen's party come out and say, we are going to come in line. We are not the Eurosceptics maybe you thought we were a decade ago. We are going to come in line. And that's kind of eased some concerns on investors.
How much does the market really provide a check on some of the more hyper-populist and potentially inflationary policies? So under surveillance this morning, NVIDIA's wild ride slows down for a hot second. The chip giant pushing into a technical correction yesterday, erasing $430 billion from its market cap, the biggest three-day value loss for any company in history. but it's still up 140% year to date. I feel like we need that asterisk, Danny, whenever we talk about this name.
Poor NVIDIA, only up 1,180% in over the past 4 years. Tiniest violin. But okay, so yesterday you get the sell-off in NVIDIA, and I noticed at the same time Bitcoin was also tanking a lot. It fell below 60,000. So there was this sort of flavor to it where it was like these kind of short-term momentum trades going into the market. The things that have been a little bit hot started to sell off. So I've been saying this all day, and I still think it's true, that the narrative hasn't shifted. To Steve Eisman's point, the story is still big and grand and wonderful, and you can still trade it. But I think it was pretty much consensus that it looked a little bit frothy. So if anything, I don't know, it didn't make that much of a difference. But maybe it's a tiny bit healthier.
Although Mike Wilson talking about the potential for some sort of growth shock, checking that idea, Steve Eisman shrugging that off, all the sides that make a market. Apple, in the meantime, reportedly rejecting the idea of an iPhone AI partnership with Meta several months ago after brief talks. We're reporting this after what happened in terms of earlier reporting. Sources telling Bloomberg that the tech giants are not in discussions to integrate Meta's AI chatbot into the iPhone. The Wall Street Journal had reported a potential partnership. To me, the interesting aspect of this, AMH, is on one hand, Apple does seem to be in the market for a lot of partnerships. So regardless of what's right, what's wrong, there is that sort of overarching theme. On the flip side, who wins out and when does it sort of stop the everyone wins kind of feeling in the iTrade?
Right. It definitely feels like Apple is looking for their dancing partners when it comes to AI. They haven't exactly built this in-house like they normally do with a lot of their products and software and hardware. What's interesting about Mark Gurman's reporting, which comes after the Wall Street Journal, is that he's saying that Apple decided not to move forward with formal Meta discussions in part because he doesn't see that the company privacy practices as stringent enough. So maybe Apple is concerned about some of these privacy concerns, the regulation battles that potentially they see coming down the pipeline when it comes to AI. It just leaves a lot of questions open. To your point, Lisa, who do they end up pairing with for the future?
I think this is just such a different Apple. I mean, Apple is a company that usually will go to the consumer and tell them what they want and be like, here you go, this is what you get. Instead, this is an Apple that's talking about doing different partnerships and letting consumers choose what kind of AI they want. I mean, Apple literally at the beginning, when they were contemplating how they incorporate the internet, they were thinking of having their own ecosystem where you can't go off and look at other websites. It's only within the Apple world. It has come so far, and it just shows you that AI is a complicated beast that maybe Apple is behind on. So they're kind of being forced to be a different company that takes on partners instead of being the leading force.
It's not a Macintosh, it's a Fuji. Oof, terrible. All right, meanwhile, San Francisco Fed President Mary Daly says the labor market could be at an inflection point. Daly saying, quote, so far the labor market has adjusted slowly, but we are getting nearer to a point where the benign outcome could be less likely. She added, inflation is not the only risk we face. This as investors keep an eye on this week's data, including consumer confidence, new home sales, and the PCE deflator. We also heard earlier this morning from Michelle Bowman the opposite, saying inflation hasn't died yet, and we have to be cognizant of that. And we did just get Canadian inflation showing a reacceleration over the prior month. So a lot of cross currents. Joining us now to lay it all out for us is Nuveen Saira Malik and Mark Zandi of Moody's Analytics. Sarah, I want to start with you. This idea of growth shock versus inflation. Do you think that we have moved more to the growth shock risk than the inflation side?
I think it's the growth shock risk that I'm concerned about. Moves in NVIDIA and Bitcoin recently are telling us there's a cautious undertone to this market that's based on two reasons: a slowdown in the consumer and the employment markets. Consumer, we're seeing weaker retail sales, fast food companies discounting, less retail traffic. Employment markets, even though payrolls have been strong, that's been the unusual number. We're seeing unemployment claims at almost cycle highs. I think both of these are telling us that the economy is slowing. And the tough thing to forecast from here on out is exactly how slow is that economy going to get. I think we are approaching a recession in a slow manner, and the depth of that recession will be TBD and what we need to determine in terms of market premiums.
Mark, I know you would agree with that kind of sentiment, that the bigger risk here is a more significant drawdown. Do you, like Sarah, see some sort of significant downturn or recession on the horizon in the near term?
No, I don't think the recession is likely, but I do think there's enough evidence at this point for the Fed to start cutting interest rates. The economy is slowing. I mean, we track GDP growth for this first half of the year at 1.5% annualized. It's down from 2.5% last year. And that's below the economy's potential. Unemployment starting to notch higher. Initial claims from unemployment insurance are starting to push up. Other labor market indicators are showing some softness. So, and given that inflation is coming in within spitting distance of the Fed's target already, particularly if you exclude the very problematic OER, owner's equivalent rent, the implicit cost of owning a home, which is very difficult to measure. So I think everything suggests very strongly that the Fed should be lowering interest rates. And now, if they wait another month, 2 or 3, maybe even after the election, I think we'll still avoid an economic downturn, but why take the chance? Why take the risk? And besides, in this kind of environment, the economy is very vulnerable to anything else that can go wrong. And goodness knows there's a lot out there that could go wrong, including the upcoming elections.
Well, Mark, you couldn't sound more different from Michelle Bowman, who today said that there is an upside risk to inflation still, and it is not time to cut. As Neil Dutta says from Run Macro, is the Fed looking at yesterday's data? Are they behind and in potential danger of making a policy error?
Yeah, there's a real chance that they're going to make an error here. In my humble opinion, I do think that the economy is softening very quickly. I mean, and so far so good. That's kind of to script. That's what the Fed wanted, and important to getting inflation back in the bottle. But I do think the economy is fragile. The other thing I'd point out is the financial system is under a lot of pressure. The yield curve is still inverted. That's just not a very good place for a lot of banks and other financial institutions. Loan growth is slowing because of the tightening and underwriting after last year's banking crisis. Credit quality is moving in the wrong direction. Still good, but moving in the wrong direction. Regulatory costs are up. So, the system is under a lot of pressure, and when it's under a lot of pressure for long periods of time, as it has been and will continue to be with this too high for this higher for longer strategy, something else could break, and the next thing that could break might not be conducive to being fixed like last year's banking crisis was. So, yeah, I think the risks are at this point asymmetric, and the Fed should start cutting interest rates.
By the way, not only is the yield curve still inverted, it's currently its most inverted since December. Sir, would you agree with that we're getting into the potential territory of a Fed policy error with, as Mark says, a fragile economy?
Well, I think the Fed needs to be careful here about not risking their credibility. We just saw inflation reaccelerate earlier this year. The Fed has stated they need to see multiple months of data points before they start cutting rates. We're just starting to see inflation come in below consensus just in the prior month. So I think we have many months to go before they cut. Perhaps September could be the first cut, but I still only see 1 to 2 cuts this year. I think the Fed still does need to be cautious because we still have to worry about auto insurance, financial services in that PCE number this week, healthcare, all of that is still remaining inflationary, and the consumer is still pretty strong, and that's been an inflationary headwind. And so I think all of that could cause the Fed to be cautious here and not overcut and then cause another inflation acceleration.
Forgive me, I feel myself being distracted by what we heard from Steve Eisman as we talk about some of these issues, whether it was the Fed, whether it's some of the political ramifications, because he came on here and said the Fed doesn't matter, politics doesn't matter, the auctions don't matter, the deficit doesn't matter. Mark, I would love your sense of just starting with this idea of the Federal Reserve and whether rate policy will matter, why it isn't necessarily just some sort of distraction every month or so as they come down and speak, given the fact that there is this sort of technological shift underway that's kind of taken main stage in terms of story building.
Well, I think that's exactly what your previous guest had to say. But in my view, all the things you just mentioned, they matter, and they matter a lot. To people. If the Fed doesn't cut interest rates, then people with credit card debt and consumer finance loans, buy now, pay later, auto loans, home equity lines of credit, they're struggling to make those debt payments. It matters. For businesses, small businesses that have loans that are tied to the prime rate, which is tied directly to what the Federal Reserve is doing, it matters. And of course, in terms of the upcoming election, that really matters. Obviously a lot depends on what happens with Congress as well, but these two candidates have very different perspectives and visions of how the economy is going to unfold and where it's going, what policies should be. And depending on who wins, we're going to go down different paths here, very different directions. So these things matter a lot in a broad macro sense, but they, probably more importantly, they matter a lot to the American people.
Steve Eisman, though, is not losing sleep at the moment about any of these things, Mark. Saira, when you think about the politics and the geopolitics, you're actually looking at opportunities in places outside the United States. When a lot of people come around this table, they say that because everywhere is dealing with politics and everywhere there's uncertainty, you got to go for the least dirty shirt, which is the U.S. So where are you looking to set up ahead of what many are calling a coin toss election?
Sure. Well, first I'll start with three things that do matter for the second half, and that's earnings, the economy, and the election in the U.S. Now, the U.S. also comes with a premium because everybody kind of knows the U.S. story. So we've been interested in looking outside of the U.S. First of all, many of the big elections are moving behind us. We've had India, South Africa, Mexico. We're still kind of dealing with what's going on in France, but a lot of these elections are ahead of the U.S. And also in terms of inflation, many of these countries have been battling the inflation battle for longer than we have. So they're a little bit further along the curve. That makes them interesting. And then, of course, valuations are interesting. So some of the emerging markets, even India at this point, with the structural tailwinds of a younger population and consumption-based improvements over there, I think is interesting. We also like Japan, the tailwinds of better governance, the consumer in Japan, growth that's finally picking up, and benign inflation. That's also a favorable country to us. I think the EU is still challenged. They do have an inflation problem, but they don't have that growth advantage that the U.S. has because of its dominance in technology. So those catalysts plus valuations outside of the U.S. makes us want to look there for some attractive segments.
We have the first part of the French elections coming up on Sunday. Do French bonds attract you, or are they scary at this point?
I think there's just too much macro unknown in that region right now. We like to invest where we can get our arms around the fundamentals. And when you have kind of binary outcomes, I think it's challenging to invest even when valuations are in your favor. So that wouldn't be our first choice. Actually, what we do like fundamentally strong is U.S. municipal bonds, because not only are the yields attractive, but the municipalities in the states have such strong revenue bases now and such strong savings rates because of the strength of our economy. We think that's an area where you can take advantage of yields and also take advantage of strong fundamentals.
Mark, I also want to bring you into the conversation about political risk, not necessarily just here, but abroad too. We've seen it in multiple places. Saira mentioned some of them. You saw India, South Africa, Mexico, the latest being France. The IMF data shows that 50% of French bonds are held by foreigners. So you have these markets where a lot of non-locals are participating in them. Do you think, unlike the U.S. election, we just haven't been paying enough attention to risk and political risk specifically abroad?
Well, I think we're paying attention. I mean, I give a lot of talks, and when I give a speech or talk to a board and ask what's on top of mind, the first thing that comes up is geopolitical risk, and it's hard to pinpoint exactly what risk is most threatening, but there's plenty of things out there to worry about. You mentioned what's going on in France and Europe, and the various elections across the globe. Of course, the Chinese-U.S. relationship, Taiwan, North Korea, what's going on with Russia. So there's all kinds of geopolitical hotspots that can boil over. So I don't think I don't think people are discounting that risk. I think that's really top of mind. I think the real difficulty is kind of gauging how significant a threat it really is. And what are the links back? What are the channels back through which it will affect our economy? That's a much more difficult task to do and much more difficult to gauge.
We have a number of Nobel Prize-winning economists coming out today talking about the difference between a Biden election, Mark, versus re-election versus Trump winning. And this is something else that Steve Eisman basically shrugged off and said doesn't really think it matters. But they were talking about the fact that Trump would be a lot more inflationary. Is that how you view Trump 2.0?
Yes, I do. I mean, just think about the policies he's putting forward. And here, of course, I'm assuming that he gets roughly what he wants. But if he does, then it's going to add to inflation. I mean, the tariffs by themselves are going to be quite significant, 10% across the board. He's talked about 60% on Chinese imports into this country. There's an immigration policy, particularly the deportations. I mean, that, if he actually could follow through on that, that would be highly disruptive to leisure hospitality, retailing, the mining industry, agriculture. Food prices would go back up. Think about the tax cuts. They're deficit financed. There's no plan for paying for the tax cuts, and he's talking about more tax cuts. Lowering the corporate tax rate even more, which will add to deficits, and that's a stimulus, fiscal stimulus, adding to the economy's growth when it's already at full employment. And then, of course, this is now more speculative, but there's been very credible media reports about thoughts about impacting the relationship between the executive branch, the president, President Trump, and the Federal Reserve Board and Fed independence. And of course, a bedrock of a well-functioning market economy is an independent central bank. And if that's eroded in any way, that's going to result in more inflation. I can go on, but you add that all up, that's a brew for higher rates of inflation.
Is that your sense too, Saira?
Well, I think, first of all, there's good news and bad news about election years. The good news is that the markets tend to go up, which we've already seen. The bad news is markets tend to be more volatile, which is probably what we'll see in the second half. Over the longer term, it's still going to be earnings that drive the markets higher. And for, I think the next catalyst for the markets is second quarter earnings, where they're expected to grow about 10%, mostly led by technology again. So we'll see if that can be the catalyst that turns around this technology route that we're seeing. As for which president's in place, I do think we're going to have to think about international relationships, tariffs, also what happens within the U.S. in terms of infrastructure and bringing that onshoring back home. I don't know. There's so many factors that drive inflation that I don't think the president itself can be blamed just for inflation or which candidate wins, because there's so many other things like supply chains unwinding, China reopening, which could be inflationary, consumer spending, which has also been inflationary, and the employment markets, which have led to that consumer spending. All of those factors, there's so many of them that I think it's hard to pinpoint it onto just a presidential candidate.
It feels a bit like whack-a-mole, which is the reason why I think some people are saying just look at the earnings. And if the earnings are okay, then they can be all in. Is that sort of where you're at?
And second quarter earnings should be okay, expected to be up over 10%, a little bit broader this quarter than we've seen in the past, with non-tech earnings actually expected to grow about 7-8%. So we'll see if that happens. The market could broaden. That could be the positive that helps this market stabilize and recover from here.
Saira Malik of Nuveen, thank you so much. Mark Zandi of Moody's Analytics, thank you so much for being with us today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Hackes. Yahaira.
Hi, Lisa. Fed Governor Michelle Bowman says she sees a number of upside risks to the inflation outlook and reiterated the need to keep rates higher for longer. In prepared remarks in London, Bowman said a tight labor market, geopolitical developments, fiscal stimulus, and a loosening in financial conditions are risks to the inflation outlook. Bowman also pointed to a more open immigration policy in the U.S. as a reason for differences between the U.S. and other major economies in recent months. Boeing has offered to buy Spirit Aerosystems in a mostly stock deal that values the company at about $35 per share. The latest proposal represents a switch from Boeing's plan to fund an all-cash offer. According to people familiar, the final details are still being discussed, and the terms could still involve a small amount of cash. It would also require Spirit to spin off some of its manufacturing plants to Airbus. The transaction is expected to be announced within a matter of days. And U.S. travelers continue to fly at record numbers. The TSA broke a new level over the weekend, screening nearly 3 million travelers on Sunday alone. The TSA expects to break that record again this Friday as people travel for the July 4th holiday and summer vacations. They expect more than 32 million people to fly between this Thursday and Monday, July 8th. That's your Bloomberg Brief. Lisa?
Yahaira, thank you so much, and thank you for today. Up next, setting you up for the day ahead, this is Bloomberg. Does anything matter except for AI and the stories? We can get into that in just a second. Counting down to the opening bell, this does matter. Here is the trading diary for the week ahead. We'll get consumer confidence data at 10 a.m., plus more Fed speak from Governor Lisa Cook. Wednesday, we get new home sales, the mystery of the housing market. Thursday, durable goods, plus another round of jobless claims, as well as the first presidential debate. We round out the week on Friday with a PCE deflator, the key inflation metric used by the Fed, and personal income and spending. And finally, University of Michigan consumer sentiment. I do want to just go to this question of this difficulty understanding where to look and what is important. Neuberger, Berman, Steve Eisman saying investors can put the campaign trail aside. Take a listen.
This is going to sound a little strange. I actually think it doesn't matter who's president for the market overall. I really don't. I just think some of these themes of AI and infrastructure are just so powerful that it doesn't matter. There'll be subsectors where things will be better and things will be worse, but for the overall market, I don't think it matters. I just don't think it matters at all.
Anne-Marie?
Just doesn't think it matters at all. Well, good luck to us who has to cover this for the next few months. But, immediately after Steve Eisman said none of this really matters, We had Mark Zandi come on and said, actually, all of this matters, and it matters a lot. You do see the White House today, though, really leaning into what these 16 Nobel laureates had to come out and say, that a Trump presidency would be more inflationary. I think some people are saying potentially yes. How far does the rhetoric go into policy when he talks about things like tariffs and tax cuts? But then there's still a lot of unknowns, like the makeup of Congress. But to Steve Eisman, it's all just doesn't matter as long as AI is still in play.
Well, and people might dismiss this as a little overly cavalier, considering the fact that immigration very much has affected the labor market, as well as just the upward pressure of wages. You could say the fiscal stimulus has been a tremendous boost to the U.S. economy and to consumer spending. He isn't totally off, though, when it comes, Danny, to this idea that NVIDIA has been such a huge driver of sort of the preeminence of the American economy, of the technological leadership, as well as this idea that we could shoot for the moon with some of these valuations.
Yeah, but it is interesting we've kind of just coalesced around NVIDIA, because there was a point where we're like, it is just AI. It is any company that has decided to incorporate AI. The flavor is kind of changed, because now you say there's some future potential for AI. There's going to be infrastructure that needs to build out. At some point, people will start to incorporate it. But for the moment, it seems like the bet still just needs to be NVIDIA, that this is the thing that benefits. And it's the only really clear part of the narrative. All the rest is a little bit theoretical.
Well, to me, nothing matters isn't really the takeaway for me as much as this idea of lifeboats from Mike Wilson. The idea that there are these lifeboats that people have been clinging to that are kind of independent of the macro cycle. And if one of them shows some holes and starts to flood or get filled with water, people jump to the next one. And sort of the only thing that could sink all these boats at the same time is a growth scare, which is what Mary Daly was highlighting, this concern it is not linear. It's the reason why consumer confidence is important. It's the reason why jobless claims are important. It's the reason why people are watching what we get for non-farm payrolls. Coming up tomorrow, Renmac's Neil Dutta has some pretty strong feelings on this, seeing something very similar to Mary Daly. Chris Harvey of Wells Fargo, BlackRock's Wei Li, and Bank of America's Jill Carey Hall. I'm very curious about her take on small caps at a time where they're trying to get some love and then falling back. This is Bloomberg.